TJ the Wheel Joe coming at you live. It is Friday, baby. January the 30th, 5:51 a.m. Central Time, Texas time. I can hear me in the background over there, so I know we got volume. It's earnings time. It's earnings, baby. It's earnings. SoFi is reporting today. It's reporting today. Hopefully, I'll be able to figure it out. Maybe a couple of you guys that are watching can guide me on how to do it. If not, we'll just go watch somebody else's channel that's doing it already. I think I have the link, so we'll figure that out. Anyway, for those of y'all that don't know me, I'm TJ the Will Joe. I can't imagine you'd be watching me at this hour if you didn't know who I was and been following the journey. I sell puts, I sell calls for a living. I roll when it makes dollars and cents. So what I want to do now is I want to do the 1 minute with God real quick, knock that out. It's always best to start off with that first part of the day. So it's kind of dark in here, but I'm going to see if I can do my best to read it. So January the 30th, 1 minute with God. And we're talking about salvation today. So I know I'm saved, but what does that mean in my everyday life? When you put on the helmet of salvation, you are deliberately protecting your head, and this is a powerful defense against troubles in the world. You live with a new perspective because when you trusted in Jesus Christ for salvation, the Holy Spirit began to change your mind. As He works within you, your way of thinking becomes more and more like that of Jesus and begins to stay focused on what is really important. This impacts every relationship you have and every decision you make. God's response: put on salvation as your helmet, Ephesians 6:17. I will give you treasures hidden in the darkness, secret riches. I will do this so you may know that I am the Lord, the God of Israel, the one who calls you by name. Isaiah 45:3, I believe. I write this to you who believe in the Son of God so that you may know you have eternal life. 1 John 5:13. Those who become Christians become new persons. They are not the same anymore, for the old life is gone, a new life has begun. 2 Corinthians 5:17. It is 1 minute with God, guys. Salvation is probably the most important thing. It's probably the most important thing in the entire Bible. It's a gift. It's amazing grace. You can't earn it. Nobody deserves it. But that's the answer to the test. You got to get that one right, man. You got to get that one right. Peace out. So let me post this on X, and then we will get rocking and rolling. We'll figure out where this earnings call is. And go from there. My daily devotional. All right. How are you guys doing this morning? Hope you guys are doing well. What's going on, Mr. International? What's going on, Will? There's the link, man. If anybody wants to kick it with me, help me through this stream, to stay awake. Some of these are snooze fests. So let's go SoFi. I really feel like we need a banger. We need a banger call with good guidance, guys. We just do. My opinion. Fed Warsh just announced as new Fed share. Let's go. I need a SoFi pump this morning. We all do. If anybody's on this channel, we're very bullish on SoFi on this channel. DJ actually started to get a little bit worried last night. I think we're going to be in the middle of the liquidity event. Could be. I'm cutting everything in my portfolio except my two main things. Right on, man. Everybody's got to do what they got to do. Going to be hard to buck the current market sentiment, even with amazing earnings. Yeah. How's the market feeling about the Fed share? So why don't we do this? Why don't we hit present, share screen? Let's add with audio. Let's go here. And this is what I have. This is what I found. It says, thanks for registering the Q4 earnings call, January the 30th, 7 a.m., but I don't see any other way. We can always like go watch it from somebody else's channel, right? Like I think Tevis is live. So there's those options as well. So I could go over here. I could do something like this and just go watch. You see, here's Tevis right here.
Guidance.
So they got all these little nerds over here.
We got some confirmation that
yeah,
people from SoFi's actual team are watching this show. Chris Hager just said, "Good morning, everybody."
Oh, that's not what I thought you were going to say. I thought you were going to say confirmation that Kevin Warsh got nominated for.
Yeah, that too. That one's less exciting though.
For Fed chair.
That one. Yeah, not that exciting.
That's not why we're here. It's SoFi. Let's see it.
SoFi it is.
Market's a little bit red. So I picked this shirt in the dark and it happened to be red. And I'm like, go figure.
So that's what they got going on. Anyway, so let's see if we can find CNBC. See if they're talking about the Fed share and stuff. And then you guys comment on the WhatsApp group or whatever, if whatever the numbers are out or whatever, and I'll go tune in if we can't find it there. So we're gonna go here, YouTube, and we're gonna go here and find YouTube TV. So where is YouTube TV? Here we go. YouTube TV, here's Squawk Box.
Has really cut off growth too dramatically by raising rates in the face of strong growth that wasn't accompanied by inflation.
We think about that every single time we had. It's the good news, bad news. We always talk about it. Something comes out. It's either a good jobs number or a hot GDP number, or so. It doesn't have to be inflation. And we'll say, the market's down because now they think that future rate cuts are in jeopardy because the economy's running hot. That's the whole nature of what we think.
But the weird thing, Joe.
But we think about
I'm
that
able to see it on my end. I feel like you guys aren't seeing it on your end.
Why should we
maybe if I
think,
maybe if I did this right here,
slow the economy down.
You guys would be able to see that.
Productivity and there's no inflation. It's like, let it ride, baby. And actually, Besson has said they want someone like that. The president is innovative. Someone like Greenspan back in the 90s.
Can you guys hear that? Let me know if you guys can hear that. It looks like Bitcoin is getting annihilated still, guys.
And hasn't the conservative critique of the Fed been that the Fed is too easy? That has been the running critique of the Federal Reserve for decades. And when I think back on the situations that you were talking about, you're right. The market does get concerned about that, but the real actions of the Fed, as at least critique from the right, have been that the Fed is too easy.
We're good.
Think about, it raised rates in 99. Was that wrong? That was, and he let them ride in 96. Go back through the decades, Joe. And it's hard to find a case where the Fed said, well, because of high growth, we're raising rates. It does so when inflation ticks up.
Steve, let me ask you this. Because Kevin Warsh has been so critical of the Fed for so long, I know there are some people inside the Federal Reserve right now who are not huge fans.
I'm in this freaking building.
It's crazy. What's the relationship going to be like with him coming in? And I ask that specifically because the chairman of the Fed is not necessarily handed a mandate to be able to determine how the FOMC will vote on any given day. Will he be able to come in and build a consensus to say, here's what I think, and that's why I'm going to convince the rest of you that this is what we're doing?
Becky, what you're just pointed to is essentially the Federal Reserve Chair's job, right? Congress creates this Federal Reserve that has representatives from
In the
districts all through
comments,
the
what do you
country.
think's going to
I'll
happen
get to
with
the staff
SoFi
in a
today?
second.
Do you
That's a
think it's
separate
going
order
to
because
pump like
Warsh has
crazy? Do you think it's going
criticized
to
staff.
dump?
He's criticized the
It's
PhDs,
going to be
criticized
flat.
the elite
And then
running policy.
on the
And he
earnings, do you
also has
think
said
it
the
will
policy
be a
has been
triple B?
favoring the
I
wealthy
think they
rather
just
than
announced the
people.
earnings, guys.
And I think
I think
rightly
they
so
just
when it comes to
announced the earnings.
criticizing, by the way, the Fed's actions during the pandemic. But
Right.
he's going to have to put a
I think they
consensus
just
together.
announced the
And by
earnings.
the way, that's one of the things that, at least in our Fed survey, is something that makes people a little less concerned about whoever this chair is going to be, is that the committee is still there. He still
I
needs
think-
the committee.
I think the
He has
earnings
to work
are
with
out.
them.
I think the earnings are out, guys. So let me go to Yahoo Finance, because I think I just saw something on my phone. So let's type in SoFi. There we go. We got a little bit of a pump. A little bit of a pump. We got a little bit of a pump here, guys. Nothing crazy. So let's go see right here. News headline: SoFi Technologies has entered a partnership with GoTo Technologies to enhance its financial wellness offerings. Despite this expansion, concerns regarding the whatever. That was 23 hours ago. I could have sworn I saw earnings here. It's already pumping. Let's just go to Tevis's channel and see what they're saying about it. Who's this? Is this Crossroads? Let's watch Crossroads channel.
We're up 5% in pre-market.
Here we go.
And more importantly, my coffee's almost here.
Yeah, up 5. I just don't really like this freaking the
Format.
way it's being shown. But yeah, I can throw it up. So it looks a little weird here. We'll get the actual report, but Jesus, freaking annoying thing.
Can y'all actually post
Fee-based revenue of
here we go.
53%, adjusted EBITDA up 60%. Product growth actually accelerated faster than member growth, which is always great to see, higher than I expected.
There we go.
Announced 2026 guidance and medium-term guidance. So we probably got 2028 numbers here. Let's go ahead and see.
Just above lending, you get just above the lending part, you will have the 2028 a little bit. You've passed it.
Text Crossroads and tell
It's in here.
Tell them that I'm watching
Just
his channel
above
on
the
live
part where they
feed.
talk about lending originations and average balances, you will have voila here
Roy, where's
over the
Roy?
medium term management
Crossroads.
expects this part.
Net revenue of at least 30% from 2025 to 2028. I mean, that's pretty strong. Additionally, management expects to deliver compounded annual growth in adjusted earnings per share.
Chris is saying Noto's on CNBC in 5 minutes.
Okay.
So maybe you can.
Yeah, I'm doing it.
get that up. Cool.
Yep.
These guys got it covered. I think
Additionally,
we should
management
just stay
expects
here.
to
Is that
deliver
good with you
compounded
guys?
annual growth in adjusted earnings per share of a 38 to 42% from 2025 to 2028. This guidance assumes that there's no meaningful change in macroeconomic environment, no significant new business launches or acquisitions. Once again, that was just like 2026.
Yeah.
But what was a full year guidance? Is it right around here, or did I? Okay, looking forward, management expects the increase of total members by at least 30% year over year. Management expects to deliver adjusted. By the way, this is a stronger guide than what they originally gave for 2025.
That's actually insane. And these are after large numbers.
After large, yeah, exactly. Net revenue, which implies 30% annualized revenue growth, adjusted EBITDA margins of approximately 34%. That is higher than their long-term guidance of 30%.
Tanner sounds excited.
Net income of approximately 18% margins. Lastly, we expect EPS will be approximately 60 cents per share. I'm a fan of this guide. It's not like, obviously they need to be conservative because they need to, like, they're still going to beat and raise, but at least it's, they're showing 30 handles in front and saying, hey, we're not looking to grow in high 20s, mid 20 ranges. No, we're looking to grow at 30+% rates, at least 30% year over year.
Yeah, I think this is what we were talking about last night with guidance. I actually think that they're being as conservative as always, except they see a little bit more favorable macro and they see that they're absolutely killing it. And so they must raise. I still think that this is pretty strong sandbagging. But yeah, it's a nice increase. No complaints.
Wow. Stock is up 4.8% right now. We'll see if it holds, but yeah. Neil, what are your first thoughts?
I mean, I was not that aggressive with my predictions, but I mean, they surpassed it quite easily as always. The guide is great. This time it's not, 1 year ago, the guide that we've got at the start of the year was like, okay, we knew. I mean, it was super easy, very, very low ones, growth rates. At least this time they're starting the year with a bit more aggressive guidance. But again, we know that if they give us these types of numbers at the start of the year, then 12 months from now, we will look back and say, okay, they've raised guidance 3 times already. So, 2026 looks like it's going to be another amazing year for the company. So, as always, no complaints here for SoFi, contrary to what might happen on Tuesday, Roy.
Yeah, it's the pain.
How are you guys feeling about SoFi right now?
It looks like from the technology platform, most likely we did not see a $33 million increase from Chime.
I've got over 250,000 shares on my.
So if they did, that's abysmal.
I've got.
So I don't think that. I had, I think, 156, 157 with the 33 million in there. So that would be right in line if they didn't receive that for some reason. That'd be coming probably the next quarter.
Expiring in like 20 days.
Wow, look at accounts.
I'm just kind of doing that over and over. A TJ special
increased
covered call.
Yeah, down 23% year over year to 128 million.
Yeah, but that's probably Chime or honestly, the technology like Galileo and Technisys have not been good.
No, but they were at 157.8 in Q3 and million accounts, and now they're at 128.4. So
so they do say it includes the impact from a large client which fully transitioned off the platform.
Yeah, I can understand that, Terrence.
Yeah,
but man,
I mean, there's definitely been rumors that Robinhood was leaving the platform, that Chime was leaving the platform.
They have tailwinds now. So
from what I heard is that a lot of these, larger institutions do not want to end up giving a lot of their data over to one of their larger competitors, right? They try to build it in-house. They try to build it with a company that doesn't also have their own, business in the same space. This is why they're transitioning over to, United Air and Southwest Airlines and T-Mobile and all of these, because they're not competitors, and so they don't feel threatened by, using their product. But also, Anthony Noto will talk about it in the call. It's not just It's on
CNBC right now, or not yet?
No, it just says commercial break right now. Okay, let's see. Total fee-based revenue across the business surged to a record $443 million, up more than 50% year over year, now generating nearly $1.8 billion on an annualized basis. This was driven by strong performance on the loan platform business, which generated $194 million in adjusted net income, up 15% from the third quarter and 2.9x from the prior year. The loan platform business is now running at an annualized pace of $15 billion of originations and $774.6 million of high margin, high return revenue.
Yeah, that's really strong.
Yeah, that's.
I thought we might see a little bit more weakness in the financial services platform and on the lending platform just because of Blue Owl and some issues that were there. But yeah, maybe not.
Maybe they diversified into a lot of other customers. That's the only problem is like, I still don't have their presentation, by the way. I don't know if, oh, actually I do now. Let me switch off this terrible freaking thing. Shame for making such
Roy
a bad
just
UI.
text me. Let's see if he's going to flag me.
Okay. Continuous innovation
like,
and brand
okay.
building. They end up talking about all the products that they ended up launching. SoFi launches paid SoFi Plus subscription, AI-driven capabilities with Cash Coach, SoFi Pay, SoFi Crypto, SoFi USD. Yeah. Okay. 13.65 million new accounts. They added 3.58 million this quarter, and they said they're going to grow by another 30% next year. So, sorry, what's the math on that? 13,615. They want to get to 17.7 million members is the call for 2026 by the end of 2026 right now, assuming that we don't beat and raise. I mean, okay. New products added for the quarter were at 5.53 million, sorry, for the year. Stock still up 3.8%.
Fee-based revenue, dude. Holy crap.
I know. I know.
Just look at that chart. The middle chart. It's insanity.
Yeah. That's crazy. But the main part here is the fee-based revenue as a percentage of their total revenue mix, right? That's what's going to matter. Because then the people who are saying that, oh, you know, it's risk-based revenue and just because they're counting it as revenue doesn't mean that, you know, it's not going to adjust later on if credit performance ends up getting worse or something like this. No, this is fee-based. This is money in the pocket. No one's coming for it. It's SoFi's. Rule of 40 was 68, faster than last quarter as well. And this is, look at this. These are the capital raises recently. So tangible book value, 8.9 billion. They did 39 cents of EPS. Yeah.
Massive.
Pretty nice. Pretty nice. Financial services. Okay, wait. This. Oh, I got to plug numbers. Oh my God, dude. I love SoFi earnings. Whenever this comes out and I get to do all the work again.
He's like me whenever I do it.
Like, look at this. Look at what they were selling
their
personal loans at. 106.5% gain on sale margin. And this line, this you know, sort of black line here is what they marked it on their book as. Okay. So even though Wall Street has constantly come out and said, look how, you know, look how expensive their loans are. Just because you say that your fair value on your loans are this high doesn't mean that it's actually true. Like, this is what Wall Street was tearing us apart for every single quarter. And then SoFi ends up saying, okay, but we'll just actually sell those loans for way higher, meaning they're actually essentially downgrading how much their loans are worth. They're being more conservative. But the numbers are so high that Wall Street has a hard time believing them because, well, they compare it to competitors and they don't have these numbers.
And these are not little volumes either. Like they could say, oh, it's a small sample size of what. No, you cannot say that at this point. So I think that there'll still be some disbelief over the numbers, how good they are. But yeah. The only one I'm not seeing, and I know we'll get to it, like, is the tech platform. There's not clarity if it includes a 33 million from Chime or not. If it does, and I'm sure analysts will probably ask this question, that's like the one weak spot. Now, tech platform is less and less relevant as far as a revenue driver for SoFi. Yeah. So not the biggest deal, but it could shift the narrative a bit.
I mean, I've been saying for
Go ahead, Neil. Sorry.
Early 2026 is supposed to be the year where we do see some growth in the tech platform, as promised. I think, what was it, 2 quarters ago or something like that? So
yeah,
hopefully we do
Q1
get
is supposed to be quite a good quarter for the tech platform. But we'll see. That also lined up with whenever they were supposed to see Chime payments come through. So who knows if maybe they're, I don't know, sort of amortizing out their $33 million payment from Chime across the rest of the year or something. That's why we didn't
look at Chris's comment from 7:15 says it includes the Chime fee.
Okay, that's
it does
really
include the Chime fee.
not good. But thank you for the clarification.
Somebody says CNBC Noto. Let's hear it.
I don't see him. He's not on. Here. I'll and he wasn't on before. They were talking about American Express. So I'll keep it live. I promise you guys, I'm watching.
Did you cover guidance yet or no? We're going there.
Yeah, we covered. You didn't see guidance?
Sorry, I was picking up my coffee.
No, we talked about it anyway. 2026 guidance came in at least 30% growth on revenue, 30% growth on members. Adjusted EBITDA is going to grow at 52%. Net income going to grow at 72%. Diluted EPS of 60 cents at least. Okay. But then they also, maybe they didn't put it in here, they also did 2028 midterm guidance, and they said that they're going to grow continuously at 30%, assuming that a macroeconomic environment does not change.
That's exciting.
But how long's the Trump term? That's through 2028, right?
Mm-hmm. Yeah.
Yeah. So we're probably not going to see crazy changes in rates or anything along these lines. So I don't know. Maybe you can assume a dovish Fed through that period. Who knows? That's speculation.
And like banks will always be a little bit more conservative on that. They just will by their nature. And they kind of have to.
I'm staring at these.
You don't want a bank that's like constantly putting their pedal to the metal, full throttle, assuming everything's going to be great. At some point, it won't be.
Exciting.
And then you no longer exist.
It's what's so awesome about earnings.
Their own assumptions were quite pessimistic, right?
You remember
5% unemployment rate or something like that for the last year and a half. So
it's like a reminder, right?
They're playing it safe and they are over delivering. That's for sure.
I feel like this could happen with Palantir next week as well.
Okay, Tevis, can you take over on this press release? I'm just going to plug some numbers.
Just plug the numbers.
Maybe they need to report like every 2 months.
Yeah, but I would like to talk about like we have 45 minutes.
This is great. I think this is going to help out a lot of y'all's portfolios.
Anyone knows anything about this possible new
congratulations, guys, for hanging in there. I think
he's hawkish
for everybody.
He's hawkish. Great stuff.
Well, he's more hawkish than Hassett, that's for sure.
So there might be a specific reason why he got chosen, because I mean, Trump doesn't like high rates, so I guess something needs to work there.
Yeah, I mean, I think the thought process right now is that Besant was the one that chose versus Trump. But yeah, that's why the market's reacting the way it is. Because if it was Hassett or even Reader,
BlackRock,
then I think both of those guys are more dovish than Powell, but this guy is definitely hawkish.
And you still have a possible government shutdown.
I think that was averted.
Well, on Kalshi, I saw this morning it's still at 65%. Unless people like to lose money, I don't know.
Yeah, I think that's a lot higher than it should be. But
the futures are recovering nicely.
I think that there's still a chance. Like if I was reading it correctly, and it came in, last night. So we'll have to see. But there's still something that need to be done there. But
I'm pissed off the stock gods. I didn't light the right candle.
Tevis, you taking over here?
Yeah, sure.
I'm waiting for you.
Yeah. What do you got? Okay, sure. Here.
SoFi's up 4% still, guys. Not bad. Not bad.
Oh,
Not
I'd go to the
bad.
presentation. That's what I would, or sorry, the press release.
Sure. All right, let's run through this and let Tanner enter his numbers.
Teamwork.
Yeah, is there anything you guys specifically want to jump into?
Yeah, the products is really interesting. Go down to the products highlight, because that's, we're used to seeing a certain ratio of new members to products, and of course the thesis has been for a long time that we'll see an increased adoption. Just scroll up just slightly and stay on that for a second. We'll see increased adoption as they continue to offer more products, as they have more members as well, and as the value is just apparent. People oftentimes like to have many of the same things in the same ecosystem, myself included. This seems to be continued validation of that thesis. So they added a record 1.0 million new members. These are new, so this is not net. You'll see a different number on the slide as a result. So keep that in mind. But leading to a 35% year-over-year increase, and then at 1.6 million, typically we would see like 1.5 if there's a million members added, and there's some that churned off as well. That's a very healthy. That might be like the largest spread since I've been an investor. In gains in new products versus new members since May 2023. So really, really good. That's a standout number to me. What do you guys think is maybe driving the new product adoption there, like in the short term? Like they mentioned a few things, but it's
I think low barrier to entry products, man. I think there was upgrades to Relay in December, right? They launched the new credit cards. Of course, crypto contributes to that as well. So the more products that they have, just from a sheer number perspective, that are low barrier to entry products, then they're going to increase that cross buy. So I put it here: cross buy reached 40%, 7 points higher than a year ago quarter, demonstrating the one-stop shop model.
Have they broken that out before?
I think they have talked about it. I don't know if there's an actual diagram on the cross.
Yeah. I mean, I like extra information, and I don't remember seeing that. I remember it being mentioned a couple of times, but yeah, it's nice to have the visual there. Yeah, this is central to the thesis of SoFi. Is if it was just a lending platform, it's a really good one, but that's not the full thesis at all. So.
By the way, guys, he's still not on CNBC. Stocks up 4.5%, 25.44. It's going to come down to the call, and then even then, whenever the market opens, that's a completely different situation than what we're seeing at the amount of volume that's coming in at 7:23 Eastern Standard Time. But
personal charge-offs down 57 basis points year over year. Very healthy. I mean, that's not just healthy, that's great.
Yeah, I found the originations was actually really interesting as well. Hold on, this is the slide that I want to.
Yeah, let's take a look at it.
Because they broke out originations for the LPB versus the rest, and look at the boost, man, in student loans and home loans for the fourth quarter, and then you also see the boost in personal loans, and they split it out between loan platform business in gray. And you can see the sort of year over year there from 1.1 to 3.6, and then their own personal loans in blue. But overall, pretty solid originations in the fourth quarter across the board, across all of their lines.
Yes, absolutely. And I can pull those up just so we can see the quarterly. Give me
more huge quarters for SoFi Money, SoFi Invest.
Yeah. Maybe we can jump into the product breakdown. Any thoughts on that, Neil? I saw you on mute.
No, I was just wondering if Tanner, if you have a slide that might show how many products per members or how many members. Yeah.
Plugging right now, but I gotta.
So. Yeah, Relay 6.6. Wow. Big jump, man.
Crypto, 63,400 accounts for crypto. Crypto's a new product line.
That would be it. Well, that would be a help towards that product number. Yeah.
So they say product counts for crypto in the fourth
I
quarter
wonder if I
25
should
reflect
start
activity from the
buying
launch on
Bitcoin on
December
SoFi
22nd through December 31st.
versus
Wow, that is just
Cash
a
App.
week of crypto, and
They're like
therefore not
8,000
representative of
already
full
over there
quarter
on the Cash
performance.
App. I wonder if I could move that over
So
to
keep in mind,
SoFi.
guys, the 63,000
You know, because I'm buying 25
products
bucks a
is just
day
for a week.
just to like have everything
Wow.
in one spot because I got
Yeah, there's some good incentives
I
there.
don't know, like
But yeah, they have a.
120 shares of SoFi
It'll be
over
interesting
there
to see how
on
the
their
Clarity
app
Act works out.
that I buy
But,
those
they're a
shares with
bank. They're
rebates on
issuing
credit card.
stable coin. They're not worried about this. So
I forgot you could buy Bitcoin.
lots of
on SoFi
advantages
now.
for them.
Interesting.
I'm going to assume that crypto falls under financial services as I add this to the other product lines, not just lending.
Correct.
Okay.
Annualized revenue per product is up 29% year over year. Not bad at all.
Blanket.
$104.
Stock's going up 4.8% right now.
Revenue per product? Yeah.
Annualized revenue per product, yes.
Yeah, credit card performance really helps with that instead of it being death to that number.
Dude, I have so much weight off my shoulders from, guidance not being like the 30% growth. I was so worried about them saying something like 26, 28% growth, something like this, and then upping it each and every quarter. The fact that we at least got a 30 handle just at least allows them to say, you can call us a bank, you can put us in these sort of categories, but the number of companies that you can put us with that are expected to have adjusted EBITDA of 34%, and that will be better than expected with 30% growth. So they're immediately shooting for essentially a 64%. Or sorry, no. Yeah. I'm correcting myself and then denying myself. But a 64%. What do you call it? Rule of 40. Chris said he's on in just a second, but I'm seeing Starbucks right now. But
I love the fact that we have and just communicating these things.
Yeah.
Well, he's just saying what's available.
No, exactly. It's
so helpful,
public, but it just helps navigate.
Okay, quick thing. The thing I just mentioned, the annualized revenue per product is up 29% year over year, but flat quarter over quarter. So 2 quarters in a row, $104. In Q2, that was $98, I think. So
sorry, could you say that again?
The annualized revenue per product is at $104, same as last quarter, but still up 29% year over year. Got you.
Products per member increased to 1.477, so it increased by 0.09. I'm going to remove crypto here for a sec just to see how that influenced it. No, it's still up. It's still up by 0.005, which is fantastic. One of the largest quarter over quarter changes that we've had since the only time that's been better was last quarter.
This is interesting. So no meaningful changes to macroeconomic environment.
Wait. He's on CNBC.
All right, put up.
$1.01 billion versus the $985 million.
Let's go, Noto. Pump,
that
baby.
On them, by the way.
Pump, Noto. A little energy, bro.
Anthony, just tell us a little bit about the quarter. Numbers did come in a little better than had been expected. Why?
Sure. It ended an incredible year for SoFi. In the quarter, we had 37% revenue growth, 35% member growth, and 37% product growth, with really strong margins at 29%, and our EBITDA increased 60% year over year. Overall, we've been driving more than 30% revenue growth each quarter throughout the year. And as we go into 2026, things look incredibly strong and guided the first quarter to 35% year-over-year revenue growth and the full year at 30%. It really reflects the innovation that we're driving, the number of new products that we're building, as well as the increased awareness through our branding efforts. So all cylinders are hitting very strongly right now, and it's coming out with these results. It's really unprecedented. 37% revenue growth with 29% margins.
Yeah, Anthony, over the last year, your stock has performed remarkably well. It's up by about 55% over the last year. But if you look at it for the year to date, it's down. And there are several reasons for that. The first would be that capital raise that you all did in December, $1.5 billion. People are a little worried about dilution there. Another issue is just you guys have all these new offerings that you mentioned. Cryptocurrency has been under some pressure, and that has weighed on everybody who is making some of those offerings. But why don't we go through those one by one? First of all, the capital raise that you did, what are you doing with the money? What do you say back to any concerns on Wall Street about that?
Sure, it was really an opportunistic capital raise. We saw an opportunity to add to our balance sheet. Many people are looking at it in different lenses, but the way we look at it is it was accretive to our tangible book value. Our tangible book value increased by more than $2 per share to $7 overall, and the capital that we put on the balance sheet gives us great flexibility to either drive faster growth in 2026. If we find something from an M&A perspective that would fortify our competitive position, we could do that. We can also reduce debt and improve our cost of funding. So, accretive to tangible book value is a really great measurement for us to evaluate these capital raises by. There's no specific use, but it gives us a lot of optionality. One of the things that happened in the quarter was we had over 40% loan origination growth, but only 15% actual lending revenue growth, because we've built this business called the loan platform business, where we use our technology and our marketing capabilities and our underwriting capabilities and our balance sheet to produce loans for other people. Now we have so much capital on our balance sheet, we're at like 2x our statutory required leverage ratios. We have an optionality to grow the business in any direction as it relates to lending that we'd like, in addition to doing things like M&A or reducing our cost of debt.
We should point out that the shares are up by about 5.3% this morning on some of this news too. But let's talk about what's been happening with crypto, some of the pressure that have been on those cryptocurrencies, and what that has meant just in terms of how you see things, what that means for the new products that you're offering.
Sure. We used to offer buy, sell, and hold crypto tokens that we had to exit 2 years ago based on guidance from the OCC. With the new administration and new leadership of the OCC in April of 2025, we were given permissibility to operate in crypto, and we've run as fast as we possibly could to get to market. We launched SoFi Pay, which is using Bitcoin to send money internationally. We launched SoFi Buy, Sell, and Hold in December, and then SoFi USD stablecoin. It's very early days, but the reaction from our members in these offerings has been quite positive. We feel like we're just getting started. We're benefiting from two technology super cycles. One is crypto and blockchain, and the second is AI. And it's unique that one company could benefit from both of those. So there's much more horizon for what we'll do from an innovation standpoint. But it's only been about a month since we've entered the two new areas that we're in. And I think the price of crypto has an impact on some companies, but we have very little revenue from it today, so it's not really a direct impact there. I think what you've seen in the sector since the beginning of the year is uncertainty around interest rates, and the naming of a new Fed chair, I think, will start to put some stability under the market as it relates to interest rates. We'll have to see how things transition with the confirmation with the Senate, and then what ultimately the new secretary decides to do.
What do you think of Kevin Warsh being named as the president's nominee to head the Fed?
Yeah, we at SoFi, I personally are huge fans of Kevin. We think it's a great choice, and really look for the leadership change and a new mindset as it relates to the role of the Fed.
And very quickly, Anthony, we have spoken with a lot of the big bank CEOs about what it would mean if the president's proposal.
And Travis eating like he was tied up all night.
Went through. It's an issue for you too. What would it mean if that cap went through for 1 year?
Sure. The revenue that we generate from credit card is quite small today. It's almost immaterial relative to the over $1 billion of revenue that we're producing per quarter now, and over $3.5 billion for the year. We have a product called personal loans, and our average loan size for a personal loan is about $30,000. And our average interest rate on personal loans is around 12%. It's about half the average interest rate of a credit card. So the demand that we get for our personal loans is actually people refinancing their credit card into lower cost debt that amortizes down. The credit card industry has a lot of different players, but ultimately you make money in that business because people keep the revolving balances out, and you can charge 25% interest. That is not a good product. That is not getting your money right. Using a SoFi personal loan to cut that rate from 25% to 12% and having it amortized down so you get out of debt is a much better value proposition. So if there is a cap on credit cards, we think the demand for a personal loan will actually go up, and people will use that as a first product as opposed to refinancing their credit card debt in the first place.
Anthony Noto, great to see you this morning, and we appreciate your time.
Pump,
Becky,
pump,
thank you very
pump,
much.
Noto, pump, baby.
Seems Becky hasn't even had her coffee yet. Holy.
Becky a little slow today?
Yeah. Becky was like not wanting to be there.
Well, so like In fairness, we talked about this last night too, Tanner. Like this week has had just a fire hydrant of like news and events. It feels like a month, and so it wears anybody out. Like it's exciting, but boy, yeah, really good questions there. The one that, unless I missed it, I don't think that they were asked about dilution, which I think they would have had the same answer. They asked about the past dilution.
Oh yeah. Future dilution.
Yeah, like, are you going to dilute right after this, Noto? They're not.
I mean, I like he kept the door open for acquisition. He said, "Hey, look, it's just good competitive position to be in. If we want to make an acquisition in 26, we can do that." So I think that's what a lot of the people watching, want to hear, because it's more sexy than saying, "Oh, well, tangible book, value is going up." But ultimately, like we said in December, like it's a trusting management to do what's best from an ROI perspective, so that it's accretive.
Yeah, I mean, they're not just going to keep diluting just to put cash on the balance sheet. There's no reason for that. So if they're going to grow their loan book, great. If they're going to acquire something, that could be good too. But stock's up 5.5%. Just going around the clock. Be honest here, okay? This is all recorded. Who said pump? Who said dump? Which one?
I said pump.
Tevis?
I said pump in the morning and fade to the day.
Okay, all right.
We'll still see.
I have 70% pump in the chat for me, so
I'm not talking about in the chat. I said, what was your answer?
I don't know. What did I say? Did I say we're going to dump?
I don't know.
Said we're
I don't
going to
know.
zero. No, I'm just kidding. I think you kind of echoed Tevis's sentiment that it might be a repetition of a similar pattern, and that macro might.
I mean,
macro is well.
When the market opens, anything can happen. But I mean, so far numbers look very good, and I think it helps that the stock was pushed down a little bit over the past week or two. Even if we were closer to $30, I think the stock should have gone up. But
yeah,
I'm holding the Bears' feet to the fire.
I think the call is also going to be really impactful for this one, especially because they're going to get questions around guidance and their underlying assumptions with guidance and so on. So I'm expecting some price movement upwards during the call Q&A.
Okay. Anything else on the did we look through all the quotes and everything that Anthony had said?
I think we got all of them. Yeah. So what are you wanting to hear most on the call? Like specific information. For me, it's I'd like to know a little bit more on the tech platform and expectations. It's since that includes Chime's number, that's I think lower than any of us were expecting. And it's interesting because Chime said that they would maintain contractual obligations through the first quarter. But yeah, it's odd.
Well, interestingly enough, on the tech platform, Roy, what they've said in the past is to expect an acceleration in Q1 of 26. And guess what? Starting, right now we are in Q1 of 26. So we should be expecting a big jump, essentially, or at least
What are you guys' thoughts on the earnings so far? Do you guys think the earnings I thought the earnings were pretty good. I mean, I looked at the numbers. I definitely thought that we're going to get their first quarter of the 1-in-1, right? $1 billion in gross revenue and 1 million plus members. So they did it. I mean, they did it. This has not been an easy road for SoFi, guys. I mean, it just hasn't been an easy road for SoFi. They've had a lot of headwinds along the way. And the reason that I'm more bullish now on SoFi, even than when SoFi was $7 to $10, is because they finally have a lot of tailwinds as well. They've got a lot of tailwinds at their back versus headwinds. And I'm curious to see how they perform in that environment. So pretty excited, pretty excited. Let me know if it's lagging or whatever, because I could switch over to my hotspot, because I feel like my internet might be a little bit slow. So let me know what you guys think. and then we'll click it back over to Crossroads channel, to Roy's channel here in just a second. I don't see. They're not on the earnings call yet.
Turn and trend.
eToro still doesn't have options after so many years of people asking, but
I did not expect eToro to be so small. 2.5 billion for eToro.
It has been beaten up. Tanner, if you guys are interested in that, Tanner did a good video on it too. Devin Ryan's been covering it and pounding the table, and it's definitely undervalued. I think it's lower quality than some names that we follow, but it's
am I the only one that uses it?
Okay, wait. So Neil, I will not keep on the eToro talk for too long, but
go ahead.
All I've heard is bad commentary about the user experience and that fees are high. Can you give me some user experience?
The fees are okay. User experience, it's a very, very easy platform to use. So I don't know who complains about it. It's very easy to use. It's very simple, unless you're doing some portfolio copy trading or whatever. Just to buy and sell, it's very easy. Fees wise, they did implement, I think it was a year ago or something like that, like a flat $1 fee when you do buy a stock. It doesn't matter the size, and then you have the usual spread. Okay, it happens everywhere. It's like it's no commission, but okay, you are anyways paying a small price to buy, but don't think it's the most expensive platform out there at all. And again, they don't have options, so it's crypto and stocks. That's basically what you have. Maybe it's expensive if you're buying
they have
CDFs
commodities
or
and
things
stuff
like that.
too, right?
Yeah. But
sorry. I think that there's a better acquisition target for them if they want to go brokerage route. It's public, just like easy. The culture fits very well. They have a very good AI product. Alpha is really, really good. Platform is really nice to do crypto trading, and they do a lot of the different things that Noto has talked about in the Invest platform as well over the last few years. Same mentality as well. Like even as far as like people getting their money right, they've criticized predictions market. Like I don't know about like the financials and everything. It is a private company, but in talking to Life Abram, like he would fit very well in SoFi's ecosystem. So hey, SoFi guys, if you're looking,
$29 cover
have a
call
conversation
expiring
with them,
on
so.
SoFi.
how big is it?
They're valued
80%.
currently around
29 safe,
1
guys.
point, or 983 million. They peaked at
those shares were
1.2
to get public,
billion
it's
when
only
they
100
raised their
shares.
P round in
This is, I don't have a lot
2021.
in SoFi.
I thought they were like a $5
the
or
actual
$6 billion
platform.
business.
This is
No.
they
The
raised
plan
they
was
raised
to let
the
the shares get called away,
D3
move the money
round
back
in
over
March
to
of
my
2025,
bank,
25 million at
and just keep
983
buying the
million valuation.
$75 a day with Bitcoin with that.
So it's
money.
possible.
So that was
It's only available in the US,
idea
right? Or
behind
maybe
that.
Canada as well, or
No, not Canada.
so
the
just
US.
US. Okay, so eToro gives you a bit more than that, but I guess cheaper is public.
75 countries in eToro. Dude, do you know this, Tevis? They ended up buying Bitcoin on their balance sheet. What price do you think eToro?
So on SoFi,
eToro ended up buying
25.90.
Bitcoin on their balance sheet. What price do you think their
24.30
initial
over here.
entry
I'm
price
not
was?
sure what they're
This year?
saying.
They started a position.
No, I'm not going to give that away. That would be too.
No, it was a long time ago.
I mean, since you're bringing it up, but yeah, I'd probably say $500.
It was $5.
That's crazy.
Their initial purchase price of Bitcoin was $5, and Vitalik Buterin came in to interview Yoni back whenever he worked at like Bitcoin Magazine to ask him about why they were interested in Bitcoin. They wrote the initial white paper on tokenization of equities.
Wow, that's crazy.
They are crypto fanatics.
But you see, the problem is the lack of execution. Because if you compare it to a Robinhood, I mean, Robinhood has
7% right now.
Yeah, it's pumping right now.
Yeah.
Pump. Okay.
7:45 when normal people wake up, they're like, "Oh, this thing's up."
Too many people that saw this name just going down for 3 months, thinking that that's just because that has created a trend that has to continue to happen. That does not need to happen.
And if you look at the financials, like, okay, they didn't hit the 50% that I thought that they would. They lended a little bit more conservatively. It does take a while to actually monetize off of that. But 40% plus growth on a consistent basis on a company this size that is S&P 500 eligible, that gets people's attention. And it's not just top line growth either. So great company, and it is undervalued.
Yeah. Yeah. It was one of their, I think you could say, like, slower origination quarter over quarter changes than they usually have, which does make you think, what are they doing with all this cash? 14 minutes till the call. This is going to be pretty exciting.
So on the guidance, Tanner chimed in there, and I mentioned too, like Tevis and Neil, like how sandbagged do you think the guidance is? Because they did raise, and probably a little bit more than would be a typical SoFi raise. Is that just same conservative number, as far as sandbagging, but they're just like, hey, macro is so good and we know what we're doing. Like, we're still being very conservative, but it's going to be amazing. Or like, where do you think they actually come with that 60 to 80 range?
I think it's fairly conservative from a guidance perspective, but at the same time, they don't even know like what the final decision is going to be for the Fed chair. Like, I think macro environment can fluctuate if we get more dovish. I mean, if Kevin doesn't go through, or whatever the case may be, like, there's an unknown there around the macro, and so that is underpinning their guidance. And so I understand them to be more conservative, but it did feel conservative to me. I think they're still continuing their strategy of just, sandbagging and then beating and raising. Neil?
I mean, are we expecting rates to go up this year? Probably not. So it's either going to be flat. I think we're still going to get a cut. So even 80 cents, I'll be very happy with 80 cents. If they can do more than 80 cents, that's even better. But they are also entering now another growth stage of the company. So I guess they are putting the bar a bit lower, although it's higher than what they previously did. So I'm still expecting the usual beat and raise, unless something drastically changes
I'm
with
to
the
get my
economy,
little vibration
and they have to adjust.
shaker,
But
guys.
I just don't see that happening.
I gotta shake it out this morning to get the blood flowing. I am sleepy.
I still expect beats and raise.
Yeah, I'm about to see a lot of jiggle here.
Let me respond to that, why the rates are important, because I don't think anybody's expecting that rates are going to get raised, but depending on the number of cuts we get in 26, which is going to be depending on who passes through on the Fed, it's going to matter for the total addressable market from an originations perspective for home and student. And if 26 is the year that they expand loan platform business outside of personal loans, then all of a sudden that's going to be really relevant to how their revenue profile looks, right? So there's assumptions baked in there, but Chris Lapointe was talking about this on a fireside, saying, every I think 25 or 50 bips that it follows, their total addressable market for student loans goes up like 50%.
Yeah.
But what are the expectations for cuts this year? Only one, right? One or two? One, I think.
I think you could say 1.5.
Well, we don't know SoFi's, but CME Fed Watch, and it'll be interesting to see how this moves today with the Kevin Warsh name that's out there. We're currently at 350 to 375. Consensus is all over the place, but 33.4%, the highest number, has 2 rate cuts. So 22% have 3, 25% have 1. So wouldn't be surprised if SoFi's own expectations is, again, like 1.5. Probably it'll be 2, but we'll have to see.
Okay, let's. I want to quickly switch the topic really quick. One of the things that I find is interesting. I'm not going to bring up a specific stock or whatever, but obviously we've been talking about SoFi for some time. So there's a tendency whenever looking at markets that people always try to find the next new name, right? There's been a couple names that have been floated that
SoFi
over
is
time
the
end up
next
triple
SoFi,
beating,
bro.
raising guidance over time. And that's really exciting for markets because they're going to continue to do well and the numbers look great. But that's exactly what SoFi is doing. And this might be an old name to retail, but whenever you're thinking about compounding wealth, it doesn't matter how in vogue a name is or something like this. It matters that, you know, they continue to make more money and profit over time. Whenever you talk about SoFi here, and we take a look at 2026, the consensus still for full year of 2026 is at 58 cents. Even SoFi, the king of,
bear with me, I'm trying to wake
setting
up,
expectations low,
so I
is
get on this
putting it at
vibration
least
plate 'cause it's
higher
real good for the
than Wall
lymphatic
Street
system.
expectations.
Gets all the
Some
juices
people's
flowing
range,
for me.
by the way, there's somebody is saying that we're going to see 47 cents for next year, like below their midpoint guidance. But then even out into 2027 and 2028, now they're guiding for, you know, 30+% growths in revenue and even higher rates in EPS. So all of these ranges are going to need to change tomorrow.
Yeah. So just hover on that for a second. 47 cents to 67 cents of EPS. SoFi's own numbers is 60 cents to 80 cents. That just was announced today. So what that's going to do is later today, all of these analysts are going to be forced to raise their estimates to at least be in line with what SoFi themselves is saying.
Well, I mean, they don't need to. You see the range, 47 cents. They weren't even listening to the 55 to 80.
They'll look stupid if they don't.
Yeah. Even what typically happens with numbers like this, and it's not just guidance, but it's actually numbers that are backing it up, is even those that are bearish and pessimistic, they'll raise by $1 or $2 their price targets just because they don't mind being bearish, but they hate to be, with a few exceptions, like ridiculous outliers. Now, sometimes there's a Gordon Johnson that does it for attention. There's one on every ticker.
What's
but outside of that,
what's the name of the? What's his name? Come on,
Cavarini, Bologna.
No. Cavarini's gone.
Yeah, he is.
Yeah, Bologna. Yeah,
Mr. Bologna. Yeah.
Bologna is our Gordon Johnson. We're up 8%.
He's not even that bad relative to, but yeah, there's always going to be one in each ticker. And there's also some outliers on the top end too, but usually they like to be kind of in a clumped range around this. I'm just really glad we talked about this too yesterday briefly, Tanner, that if SoFi came out with such conservative guidance that they look like bears on their own stock relative to where analysts are, that wouldn't have been good either. I didn't expect that, but yeah, good guidance.
Yeah. But that's what it felt like going from 2024 to 2025. It felt like we were being let down.
Yeah.
This did not feel like that.
No.
So let's see here. Adjusted
call is coming up in less than 10 minutes, guys, in about 6 minutes.
Yeah, I'll have it.
So we're looking at 2028, close to $9 billion in revenue and 1.7 or so in EPS. Is that higher than what some analysts are expecting? I don't know if we have estimates for 2028, but at least now we know where we should be going. I don't know if it's higher or lower or in line.
Here, let's see.
At least in fiscal AI, there's no 2028 there yet.
I'll check some other ones as well.
In the meantime, I'll finish my thoughts on this eToro Robinhood thing because that's what people wanted to hear. I'm jealous that I don't have access to her. I mean, I have Robinhood, but just the tokenized stuff in Europe. But if Robinhood was available in Europe, just like in the US, it would probably be my primary place to invest. eToro might have been early and first in this whole social investing, which congrats to them.
Yeah.
But the execution should have been much
really
better, and this would have been like a $50 billion company already right now, because they are
things like $150
in way more places than Robinhood. It's still, they still don't have options, which is something that users and even people inside the company that I know have been asking for many years. And it's not even something that's on the roadmap in the short term, from what I've been hearing, which is
stand on the thing for like 15 minutes and you're accident out right now.
Which is a shame. Maybe it is an acquisition target, and maybe someone else can do something better.
your legs get so stretched out.
I took a look.
Like
This
jogging
is
a couple of
dated
miles.
by like 6 months
Absolutely
ago when
not.
we were looking at Webull and then in it, and then like, I don't know about the leadership we got out. And then I looked at eToro just briefly and came away with the same conclusion, Nil. I don't think I obviously I can't put my fingers on the actual product, but my assessment was Robinhood is ridiculously high quality, and I don't know that there's anybody that comes close. I mean, like that, it's a public company that you could invest in. Not talking about public itself, like it's pretty good. But
maybe interactive brokerage.
Active brokerage, and then so like qualitatively, it's still worth something. It's still very undervalued, I think, but yeah, quality is not as high as you would expect. So,
guys, I ended up looking out to 2030 for Wall Street expectations. We have the call here in a couple minutes, but let's just I want to I apologize to cancel the eToro talk, but we got a couple minutes. The revenue expectations to 2028 is currently sitting at 5.6 billion, 2029 6 billion, 2030 $6.7 billion in revenue. Okay. What SoFi is essentially calling for is we're going to beat those expectations in 2027 at 6.1 billion, and at 2028 we're going to have $8 billion in annualized revenue. This is leagues higher than what Wall Street is putting at their 2030 targets. Leagues. Like Devin Ryan, great analyst, extremely competent. He's super wrong on his 2028 targets. You know, Anthony Noto essentially just put the nail in the coffin for long-term shareholders, saying that they won't be able to compound at this rate going forward. They're saying no, for 3 more years we're going to be putting up earnings per share 38 to 42%. Let's imagine that this company's multiple stays still, and like we're looking at this company at a price to earnings.
So the moves that I'm looking to make today,
EPS
potentially depending on
38 to 42%
how the
growth.
buying requirements
That's not
look and
assuming
everything.
that they end up beating and raising that number. What happens to the stock price compounding over that period?
Yesterday, we got another 250,000.
You know, you'd have to start adjusting for 40%. Now, maybe,
so that's going to give us a little bit more buying power.
PE ends up coming down a bit to a more reasonable level. We still end up growing at 42+% rates. The stock might end up compounding at 30%. You're destroying the market at that rate, and you're still getting a cheaper stock every year.
On the higher conviction. So what I'm looking
we're talking about a compounder. This 2028 guidance call was phenomenal.
Take, you know,
now I know that there are some SoFi people that watch. Please, guys, do an investor day.
Use those monies to buy 100,000 shares.
I would love to hear more about how you guys are going after your clientele. Who's your prime suspect or prime client, and
I'm going to close
how they end up spending, depositing.
And we should be at about
more user activity on the platform as time goes on. Because my assumption is that cohorts that have been on there for years end up spending more, saving more, have multiple loan products. But if you tell that to the market, that's probably going to be
and then
lead to an even higher multiple than what we're seeing right now. Can someone send me the link directly to the
is rolling Palantir out a year and
the
going
website is
from
bugging out for
140 strike to $100 strike, and running the
while you're
rich
getting
man covered call on Palantir,
like
and just continue.
That's the one thing about their very conservative guidance. Their long history of beats and raises,
and
is how can you look at that? Like the only thing that they've given us,
like in this environment,
that was like really quite wrong was their expectations
and ring the cash register over and over.
That's old news.
Selling a bunch of naked.
As far as the overall picture of their company,
Palantir
usually
sold the 700
by a good bit over their own expectations or the guidance that they put out there. So
got the naked calls
still
on SoFi
puzzles
right
me,
now,
like when you have
because
that long history track record,
like hedges from
same management team, same leadership, same company, and they're saying, "Hey, we're going to put out these amazing numbers." And nah, you're not going to do
money. Well,
they will. Like I don't know.
No different than
any other
buying puts, and if the stock shoots up, you lose money, right?
So great long term.
Buy puts and the stock goes
down. If anyone was sick of my channel
and
the amount of SoFi content that I put out, and you want me to diversify,
so it's
too bad. Okay.
Anyway,
it's so extremely hard to find these types of compounders.
I don't have to make them, but right
you
now
don't need to find a new name constantly.
Expansion.
I'm going to buy SoFi stock right now.
So I'll say buy the
whenever you
moonshot
find a
plate
great
on
winner,
ASST.
sometimes it's good just to double down and
And
triple
look to
down
get
on those
back
names.
into it
As
after
Warren
30
Buffett
days
says,
if it
you
still
only need a
happens to be
few
around the
winners
same
over your
prices.
lifetime. I
If
believe
not,
SoFi is definitely
well, I'm
one of
moving
those.
that money over to BMNU.
Call
So
starting.
if ASST recovers, that's part of crypto, then theoretically BMNU would have recovered. So, and I'm also able to sell calls over there on BMNU. Not able to do that on ASST right now.
All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session.
Anyway, so let's
If you would
move
like
the
to
earnings
ask a
call.
question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, please press star followed by 2. Thank you. With that, you may begin your conference.
Thank you and good morning. Welcome to SoFi's fourth quarter and full year 2025 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Unless otherwise stated, we'll be referring to adjusted results for the fourth quarter and full year 2025 versus the fourth quarter and full year 2024. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and a subsequent 10-K filing, which will be made available next month. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-K. Any forward-looking statements that we may make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you and good morning, everyone. 2025 was a tremendous year on all fronts. Our member focus drove an unprecedented level of innovation across our business and led to the strongest financial performance in the history of our company. As we begin 2026, we're positioned for another year of unprecedented results, and I could not be more excited. We come into the year with a differentiated one-stop shop model with a full suite of products that allow members to borrow, save, spend, invest, and protect better. A demonstrated track record of driving durable growth through continuous innovation resulted in compound annual growth of nearly 50% from $240 million in 2018 to $3.6 billion in 2025. A scaled member base of 13.7 million members, more than 20 times larger than the 650,000 members we had in 2018, and our highest brand awareness ever at nearly 10% versus roughly 2% in 2018. Despite that unprecedented growth, we still have massive addressable markets across our existing businesses and huge opportunities for growth in newer areas like crypto, AI, and business banking. And finally, we have a fortress balance sheet, which we further strengthened through $3.2 billion in new capital, increasing our tangible book value by $2 per share to $7 per share, giving us a broad range of optionality. This gives me great confidence that we will continue to drive durable, compounding growth for years to come, resulting in superior financial returns. I will discuss some of what we've planned for the year ahead in a moment, but first, let me begin with our key results for the fourth quarter. Starting with the drivers of our durable growth. We added a record 1 million new members in Q4, increasing total members by 35% year over year to 13.7 million SoFi members. This was our first time adding over 1 million members in a single quarter. We also added a record 1.6 million new products in Q4, increasing total products by 37% year over year. We now have over 20 million products. Cross-buy continues at an exceptional pace, with 40% of new products opened by existing SoFi members. Over the past year, our cross-buy rate has increased by 7 percentage points. This clearly demonstrates the effectiveness of our one-stop shop strategy and our ability to build deeper, multi-product relationships with members. And that is before we fully leverage new technologies like artificial intelligence. Our strong member and product growth powered our revenue growth in the fourth quarter. Adjusted net revenue was a record at over $1 billion, up 37% year over year, marking our first billion-dollar quarter. Together, financial services and our technology platform generated revenue of $579 million, an increase of 61% year over year, and representing 57% of total revenue. In our lending segment, adjusted net revenue grew 15% year over year to $486 million. This was driven by strong originations in the segment of $6.8 billion, a 13% increase from the prior year. Combined with the very strong loan platform business originations of $3.7 billion, total originations reached a record of $10.5 billion for the fourth quarter. This is our first quarter originating over $10 billion in loans, demonstrating our ability to originate high-quality loans at scale. In fact, through all of 2025, we originated over $36 billion of loans. I am also proud to report that total fee-based revenue across our business was a quarterly record at $443 million, up more than 50% from the prior year, driven by a strong performance from our loan platform business, referral fees, interchange revenue, and brokerage fee revenue. On an annualized basis, we are now generating nearly $1.8 billion of fee-based revenue, up from less than $1.2 billion in the fourth quarter of 2024. This reflects our deliberate diversification towards more capital-light revenue streams. In addition to delivering durable growth, we delivered strong returns and profitability. In the fourth quarter, adjusted EBITDA was a record at $318 million, up 60% year over year. Our adjusted EBITDA margin for the quarter was 31%. This is above our original goal of long-term margins of 30% set when we went public. Our incremental EBITDA margin was 44% as we continue to balance reinvesting in the business to drive long-term growth and profitability. Net income in the quarter was $174 million at a margin of 17%. Earnings per share were 13 cents. Finally, our tangible book value ended the year at $8.9 billion. In 2025, we grew tangible book value by over $4 billion and $2.54 per share. Our diversified business is uniquely built to deliver a winning combination of growth and returns. In the fourth quarter, we achieved a Rule of 40 score of 68%, once again demonstrating the strength of our model and our solid execution. The consistency with which we've exceeded the Rule of 40 continues to put us in rarefied air among fintechs and technology companies more broadly. Despite these exceptionally strong results, I know that we are just getting started. We are still just scratching the surface of the opportunity that exists across each of our existing products and the newer areas like crypto. Given these dynamics, I've never been more optimistic about our prospects than I am today. This is why we will continue to invest heavily to make our existing products even better by providing the best speed, selection, and experience, to build new products to help our members get their money right, and to further strengthen our trusted brand name. Our investments will power our durable compounding growth and drive stronger returns as we continue to scale. Let me now spend a moment discussing our brand building efforts, which are key to driving new members to SoFi, feeding our productivity loop and growth. In 2025, we significantly increased our brand strength and stature through our first ever music partnerships, including becoming the presenting partner of the CMA Fest and partnering with country music star Kelsea Ballerini, and by expanding our sports partnerships. More recently, we signed reigning NFL MVP Josh Allen to Team SoFi. Josh has been instrumental in showcasing the most valuable product in financial services in SoFi Plus. This partnership included ads across some of the most watched NFL games of the season and has continued through the existing postseason playoffs. So far, this has been one of our most successful campaigns ever, more than doubling the effectiveness of our advertising in the target market. This year, we also kicked off Season 2 of TGL presented by SoFi, with exciting play from the biggest names in golf. So far, the season off to a great start, building on the momentum from last year with viewing audiences up 22% versus a year ago in the first 5 matches. And later this year, the World Cup will be coming to SoFi Stadium in Los Angeles, allowing fans worldwide to get a glimpse of the nation's most advanced stadium and the most ambitious stage in sports and entertainment. Our marketing efforts continue to have a strong effect, driving unaided brand awareness to an all-time high of 9.6% during the quarter. That's up 250 basis points from the fourth quarter of 2024 a 33% improvement. Turning now to our product innovation across our business. At SoFi, we are one team united under a common purpose of helping people achieve financial independence to realize their ambitions. We are passionate about meeting our members' needs, driving us to work harder and innovate more rapidly to bring them the best products and services in the market. We call this the SoFi Way. Guided by the SoFi Way with a differentiated business model and capabilities, we are uniquely positioned to benefit from both the crypto and AI technology super cycles taking place. Only SoFi has the strength and stability that comes with being a national bank, a tech-driven culture with a track record of innovating in the financial services industry, and a large and growing member base that embraces innovation. A full set of products that allow us to leverage crypto and blockchain technology in a number of innovative ways, and a technology platform that allows us to innovate more rapidly and serves as a channel to support business clients. Since March, when the OCC made crypto permissible for national banks, we've moved with urgency to bring new products to our members. In October, we enhanced our unprecedented money movement offering with the launch of SoFi Pay, our first payment product that leverages blockchain technology to provide fast, seamless, low-cost, and safe international payments. We've already expanded SoFi Pay to include over 30 countries, including Mexico, India, the Philippines, Brazil, and much of Europe. SoFi Pay is available to all members right in their integrated SoFi app, making money movement easier than ever. In November, we announced SoFi Crypto, once again giving members the ability to invest in dozens of tokens directly in our SoFi app. As the first nationally chartered bank to launch crypto trading for consumers, our members can instantly buy cryptocurrencies from their FDIC-insured deposit account, which is a very meaningful difference. At other providers, a customer's funds sit uninsured, earning no interest as they wait to fund digital asset purchases. At SoFi, those funds sit in a SoFi Money account, protected with insurance and earning up to 4% interest. In December, we took an even bigger step forward through the launch of our own stablecoin, SoFi USD. This launch made us the first national bank to issue a stablecoin on public, permissionless blockchain. Once again, this is a meaningful step forward in differentiation versus the landscape. For every SoFi USD outstanding, we will have $1 of cash in our Fed master account, which means there is no credit, liquidity, or duration risk, and we will share economics with partners for their marketing and distribution services. SoFi USD will be a game changer for our business as it enables us to be an infrastructure provider for banks, fintechs, and enterprise platforms, positioning us at the center of the crypto ecosystem. As you can see, we're moving quickly, but we have a lot more to do to accomplish our ambitious plans over the near and medium-term horizons. This year, we will leverage SoFi USD to power SoFi Pay, and we'll continue to add more countries to the offering. Over the medium term, we plan to offer a SoFi Pay experience to people outside the United States, allowing them to receive, send, hold, and spend money anywhere, all supported by SoFi USD. This initiative could serve as a launching point to build our brand in a more global way. In 2026 and beyond, we will look to offer additional crypto products and services, including secured lending by cryptocurrencies, which will give members better rates on their loans, institutional trading, and correspondent payments and settlement via stablecoins. For members that hold SoFi USD, we will look for innovative ways to provide them with benefits such as interest or other perks. Beyond our member-facing initiatives, we are hard at work building our business banking offering, which will begin to launch in 2026. Our ambition is to be the bank for businesses and other financial institutions that want to transact in both fiat and cryptocurrencies, filling a critical gap that has existed in the market. Leveraging our tech platform capabilities and SoFi USD, over time, we will build an offering that includes institutional crypto trading, making us the first national licensed bank to offer this service, stablecoin as a service, crypto card issuing, digital asset custody and infrastructure services, and the ability to interchange fiat and digital assets in real time through our SoFi Exchange network, as well as the ability to settle transactions 24/7 on a virtual ledger. We have brought on significant expertise from the crypto and banking industries, and I couldn't be more excited to see this business take shape in the coming years. Turning now to SoFi Smart Card, which we launched in the fourth quarter. This new all-in-one card and account allows members to earn significant rewards and an industry-leading APY while also growing their credit score. Here's how it works. Members can use their SoFi Smart Card to make purchases just like a typical debit or credit card. Purchase amounts are automatically set aside from the deposits in their SoFi account in real time. The balance can be paid in full each month via funds on hand or an alternative bank account or source of funds. And all the while, members earn unlimited 5% cash back rewards at grocery stores. We built and launched Smart Card in just 4.5 months with the help of our tech platform, a feat that would not have been possible had we relied on another party. This demonstrates once again how our tech platform gives us a greater ability to customize and launch financial services products faster than competition. Beyond helping drive innovation across SoFi's financial services products, we are excited to see renewed energy around innovation within financial services more broadly. This started to take shape in 2025 with big consumer brands like Southwest Airlines and United Airlines coming to us to help them launch new programs that drive greater loyalty and engagement from their customers. Now we are seeing strong interest from an even wider range of companies, including those based internationally, who see the highly supportive business environment in the US, particularly for crypto, and are interested in launching new products here. Our tech platform business is in a prime position to support these enterprise clients. Turning to Invest. 2025 was a blockbuster year for SoFi Invest, in which we significantly expanded our offering to give members the best selection, including investments that have been traditionally reserved for the ultra wealthy. We gave members access to private companies, including SpaceX and Epic Games, access to invest in alternative investments through private market funds managed by Cashmere, Fundrise, and Liberty Street Advisors, access to invest in IPOs, including Klarna, Gemini, Figma, and StubHub. We launched Level 1 options and our own SoFi Agentic AI ETF. We made rolling over 401ks easier and more efficient, and we continue to make our user interface even more intuitive and engaging. This expanded offering helped drive a 2.2x year-over-year increase in their brokerage revenue, helping drive Invest closer to full profitability, which we expect to achieve this year. Turning now to our lending segment, which continues to drive strong revenues and allows us to support members at key points in their lives. We show up with a simple but differentiated message. We are here to help you get your money right. Our personal loan product does just that. With a SoFi personal loan, members can refinance absurdly expensive credit card debt held at other institutions so they can stop paying for other people's rewards and focus on their own financial well-being. For example, if a member is able to refinance $40,000 of debt on which they were paying 24% interest with a SoFi personal loan that has an interest rate that's 10 points lower, they can reduce their monthly payment by nearly $200, moving closer to becoming debt-free. If we translate that example across the more than 500,000 loans that were originated in 2025, you can see that we're having a massive impact on our members' lives. SoFi is the preeminent company offering personal loans, originating roughly 15% of total US prime volume. However, the opportunity remains massive as the real addressable market is the nearly $1 trillion of prime revolving credit card debt just sitting there waiting to be refinanced at up to half the rate. And that $1 trillion opportunity is before even considering the additional debt that is outside of our traditional credit box, but could be refinanced through our loan platform business. Our student loans are also designed to help our members get their money right. Here too, we have become the preeminent company for refinancing student debt, having a massive impact on our members' lives. We estimate that we will save our members over $400 million in interest expense just on the student loans we refinanced in 2025. Despite our strong market share in the student loan refinance market, we see continued opportunity for growth. We estimate the total market opportunity to be around $400 billion, which would increase by 25% if rates were to drop 50 basis points. In addition to refinance, we've launched new private in-school student loans options to help people finance their education, filling the gaps left by the federal graduate programs. These include medical, veterinary, dental, and STEM loans, with more coming soon. Turning now to home loans, where we had our best year of originations and where we are primed for an acceleration in growth when rates decline. In 2025, we originated $3.4 billion of total home loans, surpassing our prior record set in 2021 when the real estate market was at its height. In fact, in the fourth quarter, we originated home loans at an annualized pace of $4.5 billion, nearly 2x the pace of the prior year. and the opportunity for continued growth is massive. Within our own member base, about 90% of those that have home loans have them with other institutions. As rates come down and many of these members look to refinance, we'll be in a prime position to win that business. Additionally, as others within our 13.7 million strong member base look to purchase a home for the first time, we believe they will come to SoFi as a trusted partner. As you can see, 2025 was an incredible year by any measure, our best year ever. We leaned into what sets us apart, our unique one-stop shop strategy, our ability to innovate, and our relentless focus on helping members get their money right. Heading into 2026, we see a tremendous opportunity, and we continue to be energized by our values and the SoFi way to capture it. With that, let me now turn the call over to Chris to discuss our financial results for Q4 and 2025.
Thank you, Anthony. 2025 was an exceptional year. Adjusted net revenue for the year was a record at $3.6 billion, up 38% year over year. Adjusted EBITDA was also a record at $1.1 billion, up 58% year over year at a margin of 29%. This was our first time surpassing $1 billion of EBITDA. Net income was $481 million at a margin of 13%. Net income was up 2.1x, excluding one-time items in the prior year, and earnings per share was 39 cents. We finished the year strong with a great fourth quarter. In Q4, adjusted net revenue grew 37% year over year to a record $1.013 billion. Adjusted EBITDA was also a record at $318 million and a margin of 31%. Net income was $174 million at a margin of 17%, and earnings per share was 13 cents. This was our ninth consecutive profitable quarter. An important driver of our growth was the increased contribution from capital-light, non-lending, and fee-based revenue sources. Our financial services and tech platform businesses generated $579 million of revenue, up 61% year over year, and we also generated record fee-based revenue across all segments of $443 million, up 53% year over year. Turning now to our segment performance, starting with financial services. Financial services generated record revenue of over $1.5 billion in 2025, up 88% from the prior year. For the fourth quarter, net revenue was $457 million, up 78% year over year. Contribution profit was $231 million, up 2x from last year, and contribution margin was 51%, up from 45% last year. Net interest income for this segment was $208 million, up 30% year over year, which was primarily driven by growth in member deposits. Non-interest income grew 2.6x to $249 million for the quarter, which equates to nearly $1 billion in high-quality fee-based income on an annualized basis. Importantly, improved monetization continues its strong contribution to revenue growth. Annualized financial services revenue per product was $104 in the fourth quarter. That's up from $81 in the fourth quarter of 2024, a year-over-year increase of 29%, and we see continued upside as newer products mature. The successful expansion of our loan platform business was one of our greatest achievements in 2025, further diversifying our revenue and making our growth more durable. We've built this business into a powerhouse. In Q4, our loan platform business generated $194 million in adjusted net revenue, an annualized pace of $775 million, which is nearly 3x higher than the same period last year. And as we head into 2026, we continue to see strong demand from both existing and new partners. Beyond our loan platform business revenue, we continue to see healthy growth in interchange, up 66% year over year, driven by close to $22 billion in total annualized spend in the quarter across money and credit card. Turning to our tech platform, which generated record revenue of over $450 million in 2025. For the fourth quarter, the tech platform business delivered net revenue of $122 million, up 19% year over year. Contribution profit was $48 million at a contribution margin of 39%. This includes the remaining revenue earned from a large client who fully transitioned off our platform prior to year-end. Turning to our lending segment. Lending generated record adjusted net revenue of over $1.8 billion in 2025, up 24% from the prior year. For the fourth quarter, adjusted net revenue was $486 million, up 15% from the same period last year. Contribution profit was $272 million, with a 54% contribution margin. These strong results were primarily driven by growth in net interest income, which increased 29% year over year to $445 million. During the quarter, we had record total loan originations of $10.5 billion, up 46% year over year. Personal loan originations were a record at $7.5 billion, of which $3.7 billion was originated on behalf of third parties through LPB. In total, personal loan originations were up 43% year over year. Student loan originations were $1.9 billion, up 38% from the same period last year. Home loan originations were a record $1.1 billion, a year-over-year increase of nearly 2x. Capital markets activity was very strong in the fourth quarter. We sold and transferred through our loan platform business $4.5 billion of personal and home loans. In terms of personal loans, we closed $100 million of sales in whole loan form at a blended execution of 106.5%. All deals had similar structures to other recent personal loan sales, with cash proceeds at or near par, and the majority of the premium consisting of contractual servicing fees that are capitalized. These sales included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would have otherwise had if we held on to the loans. Additionally, we sold $90 million of late-stage delinquent personal loans. By selling these loans, we're able to generate positive incremental value over time versus selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. In terms of home loan sales, we closed $692 million at a blended execution of 102.3%. In addition to our loan sales, we executed a $463 million securitization of loans originated through the loan platform business. This channel provides our partners with meaningful liquidity to support their ongoing investment in the loan platform business. The transaction priced at an industry-leading cost of funds level with a weighted average spread of 101 basis points. Turning to credit performance. Our credit remains strong, performing in line with expectations and driving attractive returns across all loan types. Our personal loan borrowers have a weighted average income of $158,000 and a weighted average FICO score of 746, while our student loan borrowers have a weighted average income of $149,000 with a weighted average FICO score of 765. For personal loans, the annualized charge-off rate was 280 basis points, up 20 basis points from the third quarter. I would note that while this is up from last quarter, it is down slightly from the second quarter and down over 50 basis points from a year ago. In fact, this is our second best quarter since 2022. Importantly, the increase in our balance sheet charge-off rate is driven by mix rather than credit deterioration. In Q4, as a result of increased LPB activity, we retained fewer new loans on the balance sheet. This naturally increases the average age or seasoning of our personal loan portfolio held on the balance sheet. Adjusting for this seasoning, underlying credit trends actually improved quarter over quarter. Had we not sold any late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off rate for personal loans of approximately 4.4% versus 4.2% last quarter. The on-balance sheet 90-day delinquency rate was 52 basis points, up 9 basis points from last quarter, also driven by portfolio seasoning. I would note that the delinquency rate is down year over year. For student loans, the annualized charge-off rate was 76 basis points, up slightly from 69 basis points in the prior quarter, driven primarily by seasonality, as well as the impact of a student loan repurchase that began in Q1 2025 and concluded during the fourth quarter. The on-balance sheet 90-day delinquency rate was 14 basis points, consistent with the prior quarter. The data continues to support our 7 to 8% net cumulative loss assumption for personal loans, in line with our underwriting tolerance, although we continue to trend below these levels. Our recent vintages originating from Q4 2022 to Q1 2025 have net cumulative losses of 4.55%, with 37% unpaid principal balance remaining. This is well below the 6.27% observed at the same point in time for the 2017 vintage, the last vintage that approached our 7 to 8% tolerance. The gap between the newer cohort curve and the 2017 cohort curve widened by 8 basis points during the fourth quarter. In fact, this gap has widened in each of the past 6 quarters since we began measurement. Additionally, looking at our Q1 2020 through Q3 2025 originations, 60% of principal has already been paid down, with 6.8% in net cumulative losses. Therefore, the life of loan losses on this entire cohort of loans to reach 8%, the charge-off rate on the remaining 40% of unpaid principal would need to be approximately 10%. This would be well above past levels at similar points of seasoning, further underscoring our confidence in achieving loss rates below our 8% tolerance. Turning to our fair value marks and key assumptions. As a reminder, we mark our loans at fair value each quarter, which considers a number of factors including the weighted average coupon, the constant default rate, the conditional prepayment rate, and the discount rate comprised of benchmark rates and spreads. At the end of the fourth quarter, our personal loans were marked at 105.7%, down 8 basis points from the prior quarter. This included an increase in the annual default rate, which was primarily driven by loan vintage seasoning, not changes to the individual loan loss assumptions, partially offset by a lower benchmark rate. At the end of the fourth quarter, our student loans were marked at 105.6%, down 8 basis points from the prior quarter, driven by minor changes in the average coupon and annual default rate. Turning to our balance sheet. In December, we raised $1.5 billion of new capital in the form of common equity. This was our second opportunistic raise of 2025, giving us great flexibility to pursue organic and inorganic growth opportunities. It also allowed us to further improve our funding base. Over the past 2 quarters, we fully paid down our warehouse lines, reducing our funding costs by an estimated $110 million on an annualized basis, fully mitigating the bottom line impact of the additional shares. In the fourth quarter, including the $1.5 billion of new capital, total assets grew by $5.4 billion. This was driven by $3.1 billion of loan growth and approximately $1.7 billion of growth in cash equivalents, and investment securities. Total company-wide cash at quarter end was $5.4 billion. On the liability side, total deposits grew by $4.6 billion to $37.5 billion, primarily driven by growth in member deposits. Our net interest margin was 5.72% for the quarter, down 12 basis points sequentially. This included a 30 basis point decrease in average asset yields as we saw a modest mix shift from personal loans to home and student loans, partially offset by a 15 basis point decrease in cost of funds. We continue to expect a healthy net interest margin above 5% for the foreseeable future. In terms of our regulatory capital ratios, we are very well capitalized. Our total capital ratio of 22.9% at quarter end is well above the regulatory minimum of 10.5%, as well as our additional internal stress buffer. Tangible book value grew $4 billion year over year to $8.9 billion, including the benefit from the new capital raise. And tangible book value per share at quarter end is $7.01, up from $4.47 a year ago, a 57% increase. Let me finish by providing our outlook for 2026 and the medium term, starting with the macro assumptions that underpin our financial guide. In line with market expectations, our 2026 assumptions are as follows. An interest rate outlook consistent with the Fed funds futures and 2 rate cuts to get us to a 3.0 to 3.25% exit rate in 2026. Real GDP growth of approximately 2.5%, and an unemployment rate in the 4.5% to 5% range. Now for our specific guidance. For the full year 2026, we expect to increase total members by at least 30% year over year. We expect adjusted net revenue of approximately $4.655 billion, which equates to year-over-year growth of approximately 30%. We expect adjusted EBITDA of approximately $1.6 billion, which equates to an EBITDA margin of approximately 34%. We expect adjusted net income to be approximately $825 million, which equates to a margin of approximately 18%. We expect adjusted EPS to be approximately 60 cents per share. The guidance assumes a mid-teens tax rate, which we currently believe to be our effective tax rate in 2026. For the first quarter of 2026, we expect to deliver adjusted net revenue of approximately $1.04 billion, which is a 35% year-over-year increase compared to 33% in the same period last year. Adjusted EBITDA of approximately $300 million, which equates to a margin of 29% versus 27% in the same period last year. Adjusted net income of approximately $160 million, which equates to a margin of 15% versus 9% in the same period last year. And adjusted EPS of approximately 12 cents, 2 times the 6 cents delivered in the same period last year. It's important to note that each year we have seasonal payroll taxes during the first 2 quarters of the year, and we plan to accelerate marketing expenses in the first half of 2026 relative to Q4 2025. Overall, 2025 has been a remarkable year for SoFi. We are proud of the strong results we delivered and are excited to build on this momentum in the year ahead. Looking beyond 2026, given our differentiated model, the strength of our balance sheet, and the tremendous opportunities that exist across our business and in newer areas, we expect to deliver compounded annual adjusted net revenue growth of at least 30% from 2025 to 2028. Additionally, we expect to deliver compounded annual adjusted earnings per share growth of 38 to 42% from 2025 to 2028. Let's now begin the Q&A.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. Please keep in mind we'll take only 1 question per person at a time, and please rejoin the queue for any additional questions. First question today comes from John Hecht at Jefferies. John, please go ahead. Your line is open.
Morning, guys. Congratulations on the good momentum. I guess my question is, you guys gave some good consolidated guidance. Maybe can you break some of those details out at the segment level?
Sure, I can take that one, John. So overall, like we've said in the past, given that we're right in the middle of 2 super cycles with blockchain and crypto and AI, and the fact that we have significant capital cushion in any scenario that we could have possibly imagined, that makes us extremely excited about the outlook for our business, both in the immediate and the longer term. In terms of our 2026 outlook, we expect continued very strong revenue growth of roughly 30% year over year. As it relates to the segment for financial services, we expect revenue growth of 40% or more. For lending, we expect revenue to grow approximately 23% year over year. And then for tech platform, normalized for the transition of a large client, we expect revenue growth of approximately 20%. And then for our corporate segment, revenue should generally be in line with what we saw in 2025 on a dollar basis. As we look forward out to the medium term, we're expecting at least 30% annual revenue growth compounded between 2025 and 2028, and 38 to 42% annual compounded EPS growth between 2025 and 2028. From a segment perspective, we expect to see continued momentum across all segments. And given the investments that we've made to date, we see the opportunity to accelerate growth in 2027 and 2028 across a number of products that are just starting to scale, including our crypto business, our brokerage business, home loans, and student loans, given the rate environment. So overall, really optimistic about the outlook, given everything ahead of it.
The next question comes from Andrew Jeffrey at William Blair. Andrew, please go ahead. Your line is open.
Hi, good morning. Great to see the momentum in the business. Anthony, you've talked about driving awareness, and I think you mentioned today on the call the opportunity for refinancing at $1 trillion. It looks like perhaps that messaging hit an inflection point this quarter, and you mentioned some of the celebrity partnerships. Can you elaborate a little bit on the acceleration in KPI growth, whether it's sustainable, whether you think this is sort of the tipping point at which consumers say, hey, look, just simply a better answer than traditional banks? Can we sort of declare that we've reached that point in your business model?
Thank you for the question, Andrew. We are at 9.6% unaided brand awareness. We would love our unaided brand awareness to continue to grow, to get into the mid-20s, which would, when we get there, likely put us as a top 10 financial institution. When I joined, our unaided brand awareness was around 2%. And for those that aren't familiar with that measure, unaided brand awareness is asked in the following way. When you're thinking about a financial services product, please name 3 companies you would consider. So it doesn't ask about student loans. It doesn't ask about personal loans or any of the other products that we have. It just asks that generic question. The ability to move it from 2% to 9.6% is really, really challenging in the time period that we have. The largest banks in our country, the most well-known banks in our country, the most trusted banks in our country, they've been doing it for centuries. And some of them less than centuries, but a very, very long time. So our team has really crushed it in leveraging a combination of branded advertising and performance-based advertising. And we absolutely partner with big, well-known stars, big, well-known entities like SoFi Stadium and innovative things like SoFi TGL. We'll continue to look for those opportunities. But I'm more than confident than ever that we've reached the point where I can go someplace and someone will say, oh, do you work for SoFi? I have a SoFi account. That wasn't happening 8 years ago. It happens all the time now. And so one of our priorities in 2026 is trying to build product quality to such an extent that we drive virality and our customer acquisition costs go down meaningfully because of word of mouth, because of referrals. We're doing incredibly well now as it relates to our return on marketing spend. You can see that in our margins. You know, we delivered more than our long-term margin originally stated when we went public, which we've now increased directionally. So we do believe we can spend money and get a return on it. We have the analytics of that nailed down. That's what's allowing us to drive more than 30% member growth consistently over the last 8 years and coupling it with product growth. The 40% cross-buy number in, that is a number that's up almost 10% versus a year ago. And that's not easy to do when you're growing the business so quickly on a new member basis. So we're really hitting on all cylinders. We feel like we have the right marketing formula, but we're not going to rest on our laurels. I really want us to get that escape velocity where the amount that we spend becomes more and more efficient. And this is before implementing AI. It's really about product quality and awareness, and that filtering down to greater productivity of our marketing dollars.
The next question comes from Dan Dolev at Mizuho. Dan, please go ahead. Your line is open.
Hey guys, great quarter and epic medium-term guidance. Congratulations. Wanted to ask you, maybe Chris, about LPB in terms of how do you think about origination specifically and how much should be allocated to LPB versus the other stuff? Thank you.
Sure, thanks, Dan. So step back and talk a little bit about our origination outlook for the entire business. Overall, we had record originations in 2025, which were fueled by strong borrower demand across each and every one of our asset classes. What we're seeing so far in 2026 is that demand remains extremely robust, and we have more flexibility than we've ever had as a company entering 2026. We expect that total originations for the company will be up strongly year over year, and we have the luxury of choosing to drive capital-light fee-based revenue through our strong capital market pipeline, particularly in the loan platform business, as you mentioned, where we just signed a new partner, and we have several partners at final term sheet stages. Or B, we have the opportunity to keep these higher returning assets on our balance sheet and putting our newly raised capital to work. Ultimately, how we're going to allocate those assets is going to be determined by our overarching goals of serving our members and driving durable growth to maximize returns for our shareholders in the long run. Given that we have significantly scaled our loan platform business to over $14.5 billion in annualized volume, we've diversified our revenue to 44% in fees, and we have the excess capital, we have phenomenal optionality today. Holding these loans on our balance sheet results in the highest total return for each and every one of our loans, while transferring them through the loan platform business carries no risk and results in immediate revenue and cash as well as attractive returns for us. So we're really in an enviable position of choosing between two great options, and we're going to balance them accordingly.
The next question comes from Kyle Peterson at Needham & Co. Kyle, please go ahead. Your line is open.
Great. Good morning. Thanks, guys, and nice results. Wanted to touch on the deposit growth this quarter. It was really impressive and great to see. So I guess, is this still largely coming from member deposits? And then could you guys give us a refresher on what the recent downward beta has been? That'd be really helpful. Thank you.
So a couple things on deposits. I've said since we opened the bank that we have a competitive advantage in being able to offer our members a better value proposition than anyone else on something like SoFi Money, combination of a high APY, reward opportunities, as well as other services that we provide, like free certified financial planning, et cetera. I think as rates continue to go down, our advantage will make itself more clear. Everyone that we compete against in that top quartile, they kind of fall into two buckets. One, they're a newer bank that actually does lending, and they have an ability to provide a rate above Fed funds, but they have a deposit base that's so big they can't be too aggressive because they'll reprice their entire deposit base. And that's a structural issue that we fundamentally don't have. Second is people that are not actual banks that are using sponsor banks, and they can only get Fed funds plus 20 or 30 basis points. Because we have such a large and profitable lending business, we can use those profit pools to give a rate that's unmatched by other people. We haven't had to do that yet because we've had such great demand for our product, and that's driven the deposits. And I think we'll continue to show that we can be a top quartile APY and achieve the level of deposit funding that we want, and it remains relatively sticky. The bulk of our deposits, almost 97%, are direct deposit customers, and that is high quality primary account relationships, and that's what we're aimed at.
Yep. And the only other thing I would add to Anthony's comments, because you asked about it, is the downward beta. Since we launched the bank, we've been at roughly a 60 to 70% beta, and we would expect that to stay consistent going forward.
The next question comes from Reggie Smith at JP Morgan. Reggie, please go ahead. Your line is open.
Congrats on the quarter and strong guidance. Real quick for me, I guess it sounded like, Anthony, you sounded very, bullish on some of the new products. I'm thinking about the crypto, I'm thinking about the stable coin, I'm thinking about the smart card. And I'm curious, do you think that the innovation that we're seeing on the fintech side could spur more interest and demand from your tech platform customers? Historically, I think you guys have led with kind of card processing and things like that. Good stuff, not as interesting as some of the newer things that are kind of coming down the pipe. Maybe you talk a little bit about that, and if this could signal or catalyze like a change in adoption and growth in tech platforms.
Sure. The tech platform business is definitely benefiting from, let me say, it could benefit from the areas that you just mentioned. So, a year ago, the amount of demand or interest that we had in blockchain, in stable coins, in wallets, et cetera, for tech platform partners was really non-existent. But since the administration changed and the OCC came out with the permissibility of crypto and blockchain among banks, the amount of interest in leveraging the tech platform services has really increased quite meaningfully. We don't have anything to announce yet. We're in tons of dialogues with different types of companies. There are companies that are launching a debit card type of product in LATAM countries that's backed 100% by stablecoins. It's not backed by fiat dollars at all. And so there's a fair amount of that. There's also a fair amount of program managers for that type of product. And then, in the US, I think there's less activity from financial institutions for those services. It's more in the LATAM countries, but we do anticipate it'll spill over to the US, and some of the international companies will look to the US because of it's a more inviting environment from an administrative standpoint. I think the Clarity Act's very important because it will establish into law the permissibility of crypto and blockchain by banks. Right now, we're all relying on the OCC's interpretive letters, and it'd be much better if it was locked into law, especially if the administration changes in a couple of years. But I'd say the outlook and opportunities that crypto provide for the tech platform, as well as our own business, are pretty enormous, and I couldn't be more excited about it. It adds a whole nother dimension of growth for us, but it also drives a whole nother sort of lens of innovation across all of our products. And when you have as many products that we have, and you have an entirely new technology platform at a lower cost, at faster speed, and it's safer, it could fundamentally change everything that we do.
The next question comes from Kyle Joseph from Stephens. Kyle, please go ahead. Your line is open.
Hey, good morning, guys. Thanks for taking my questions. On the third quarter call, we talked a lot about capital markets, and I think you guys referenced a flight to quality from investors. Just kind of looking to get an update there. Obviously sentiments changed, but yeah, a little bit of a capital markets update and any implications on the competitive front on the personal loan side of things. Thanks.
Yep. Sure. Thanks, Seth. So overall capital markets activity and demand remains extremely robust. We continue to see that flight to quality that we mentioned during the Q3 call. We just had a phenomenal quarter in our loan platform business, transferring $3.7 billion of loans on behalf of others. We just signed a new partner this week for 2026 LPB, and we have several other partners who are in final term sheet stages. So overall demand couldn't be better from an investor perspective. As it relates to personal loan competition, we just had record originations of $7.5 billion in the quarter. We're seeing that trend persist into 2026. So all else equal, we feel great both from a capital markets perspective as well as a borrower demand perspective. In terms of how we're thinking about just as it relates to personal loans and growth in the balance sheet, we are expecting to grow the balance sheet in the double-digit billions, which is in line with what we did in 2025. We're seeing great momentum so far here in early 2026, and we expect that to persist throughout the year.
The next question comes from Peter Christiansen from Citigroup. Peter, please go ahead.
Thank you. Good morning. Congrats on the great momentum here. Anthony, I'm curious your perspective. There's been some areas within private credit which have seen some sentiment change more recently. Doesn't seem like it's too much in the direct consumer lending portion of that area. I'm just curious from your perspective what you're seeing from some of your private credit partners and demand flows there. Thank you.
Yeah, what I'd say is the attractiveness of our assets and our loans is tied to the returns that they have, and we obviously are focused on a prime customer in the business that we're putting on our balance sheet, and mostly what we're doing with partners. And the key is to make sure we're delivering our target return against that. We've been able to manage the performance of prepayments, the performance of defaults, and the performance of interest rates and our cost of funding to deliver great value for our partners. And as long as we keep doing that, they'll continue to be in more demand than supply. With the amount of capital we have on our balance sheet now, I think you could see our growth in originations and revenue and lending start to close a little bit. In the fourth quarter, our originations were up 40% year over year, but our lending revenue was up 15%. And so we're really servicing our partners in a great way. But we could keep more of that production if we so chose, especially given our confidence in our returns.
The next question comes from Moshe Orenbuch from TD Securities. Your line is now open. Please go ahead.
Great, thanks. Chris, you talked a little bit about the allocation between the loan platform business and the core product and the balance sheet for your lending segment. Could you just kind of tell us what the contribution from the loan platform business you're expecting in the 26 guide?
Sure. We aren't guiding specifically to origination volumes or LPB volumes for 2026, but what I would say is, we just exited 2025 at a $3.65 billion quarter, annualizes to about $14.5 billion of originations. We feel good about that level heading into 2026. We have sufficient demand from borrowers. Like I said, the new one we just signed up. We have all of our existing partners as well have extended their contracts and often upsized their commitments in periods. So there's sufficient demand from capital markets participants in our LPB program. But like we said, we have a very robust balance sheet. high capital ratios, and we're going to balance the allocation between the two to maximize shareholder value.
The next question comes from William Nance at Goldman Sachs. William, please go ahead. Your line is open.
Hey, thank you for taking the question. Just a lot of good questions already on the call. I just wanted to clarify the comment on the expectation for segment growth rate on the tech platform business. I think you mentioned it was pro forma for the large customer migration. Is there any way you could give us a baseline or just a jumping off point there as we think about rolling forward to next quarter? And then I think separately, I think that customer had spoken about like a fairly large termination fee that they would have to recognize. Could you just confirm if that was in this quarter, or if you've already recognized that, or just how that's being treated? Appreciate the detail in the questions here.
Yeah, sure. So as it relates to the outlook that Chris mentioned, he said 20% growth for the tech platform, apples to apples without the large customer in both years. We're not going to give you more granularity than that. You know, our outlook assumes no revenue in 2026 from that large customer. The deal with that large customer ended. The revenue also ended in Q4, and the revenue in the quarter from that large customer was part of our contract, and it was equal to the average of the revenue in the last 6 quarters. So I think people will characterize that revenue in a lot of different ways, but the simplistic way to look at it is the revenue was tied to the ending of the contract, or revenue came in at a level that was equal to the average of the last 6 quarters. Chris, I don't know if you'd add anything to that.
No, that's spot on.
The next question comes from Jill Shea from UBS. Jill, please go ahead.
Good morning. Thanks so much for taking the question. I just wanted to touch on profitability. You've posted some really nice progress on ROTCE. I think you posted 9% in the fourth quarter. And clearly, there's a lot of momentum in the business, and you've been leaning into capital-light businesses and growing the fee income mix. I'm just wondering if you could touch on the ROE of the business over a longer-term horizon. I think you've mentioned 20 to 30% in the past. You know, has that changed at all? Is the timing of the past changed at all? Perhaps you can just touch on the overall profitability of the business that you're building.
So I would say this: we believe we're building a business that will have superior return on equity and return on tangible equity. We still believe it's in the 20 to 30% range. We are not going to underinvest in the business to get to that number while we're growing at the rate that we're growing. You should expect that we're going to continue to manage the business to a 30% incremental EBITDA margin, and as opposed to trying to drive it higher to maximize ROE in the near term. Ultimately, if you see us growing less than 15% in revenue, you're going to see meaningful margin expansion and us driving to our long-term ROE. Between there and here, which hopefully I'm long gone by the time we get down to 15% from not on the earth any longer, because I expect to be here for the rest of time, unless for some reason someone asks me to leave. I hope we never see 15%. But we would be under-delivering on the opportunity in front of us if we didn't keep investing. So we're not just dropping it, all into investment. We're dropping some to the bottom line, at least 30 cents of every incremental dollar in an annual period. And that will give you a good indication of how we can drive returns over the long term. But the growth rates of over 30% that are in front of us this year at the scale that we're at just says we're just getting started. So we don't want to underinvest in that. Chris, you got anything else?
The final question we have time for today comes from Devin Ryan at Citizens Financial Group. Devin, please go ahead.
Hey, this is Noah Katz on for Devin. Thank you for the question. With over $3 billion raised in the back half of the year, you're entering 2026 with a substantially stronger capital position. How should we think about capital allocation towards balance sheet growth versus other strategic opportunities? And can you speak on your appetite for M&A? And also on M&A, please remind us of the hurdles and considerations there. Thank you.
Yeah, so in terms of how we're thinking about capital allocation, like you said, we have 23% capital ratios today. It's over 1,000 basis points higher than our regulatory minimum and meaningfully higher than the regulatory minimum plus our internal stress buffer. So we feel great about the position that we're in. we're in that enviable position where we can grow and put more assets on the balance sheet. These are very good returning assets that we're underwriting today, and we feel good about that, as well as the LPB partnerships, as I've mentioned a few times during this call. I'll let Anthony touch on anything as it relates to M&A.
There's a lot of opportunities out there. I would say more than we've ever seen in our 8 years here. But I'd also say the bar is really high for us. And when I say really high, we've looked at dozens and dozens of things, some of which were for sale, some of which were interesting to us. What we're prioritizing are things that can accelerate our growth versus the time it would take to build it ourselves. So one area we're very interested in is technology platform capabilities. And so wallets as a custody as a service, stablecoin as a service, being able to provide a market exchange for fiat and for different types of stablecoin. Our pay product, SoFi Pay, we launched in September. It is currently using Bitcoin and the Lightning Network to transport fiat dollars from the US to fiat dollars in over 30 countries internationally. And so is there a way for us to accelerate SoFi Pay's international expansion through a technology platform type of acquisition or infrastructure? We're also very interested in international countries and the licenses some small companies could have. In addition to that, in technology platform, we don't have revolving credit card processing and issuing. It's something we can build ourselves, but if there's a technology that's not that expensive and we don't have to pay for a business, we may do that and leverage our technology platform and core plus their processing to enter the revolving credit technology platform services space. There are some horizontal things that we've looked at, but nothing of interest. As you know, we've talked about building big business banking, and we looked at some SMB platforms to see if they would accelerate our opportunity there. The fact of the matter is they don't, and we're likely going to build that ourselves. Big business banking, that is, which we have seen really strong positive response from the marketplace as it relates to the need of these services to be a bank that can do both fiat and crypto. So we feel really good about having optionality on our balance sheet. I don't feel good about finding stuff at the price that we want. So far, what I'd say is it's all going to be organic. But if something presents itself in the area that I mentioned at the right price versus doing it internally, we would act on that. But the bar is really high. I know that was our last question, so I just want to wrap the call up. First, thank you all for joining. 2025 was an exceptional year by any measure. The more I went through our results in preparation for earnings day, the more I was able to truly grasp how exceptional the fourth quarter and full year are looking through any lens and how far we've come over the last 8 years. I could not be more proud of our team for building a diverse, resilient business that is impacting our members in an unbelievable way and that positions us to overcome whatever obstacles are thrown our way. All of that said, I think it's an understatement to say that we're just getting started, and I am more excited about what lies ahead than I have ever been at SoFi. You can rest assured that we will move faster than we ever have, we will work smarter than we ever have, and we will be more resilient than we ever have to capture the massive opportunity in front of us. Fresh horses we ride, and look forward to seeing you next quarter.
Goodbye.
That was a pretty quick sign off.
Yeah. Fresh horses we ride.
Fresh horses we ride. Dude, yeah, I really liked that. I staring at the stock up 5.5% right now. But there's a lot to go through, honestly. So was there anything that stood out immediately to you guys?
Yeah, I mean, there's a lot of things, but just a couple things real quick. One is it doesn't sound like an acquisition is anywhere near imminent, that they're going to be very selective and they're going to make sure it's the right price and right fit. I like hearing that. I think that's a good thing. I also really like to hear as far as there was a small little mention, but they reiterated again that they're going to be using crypto to empower lending. That's a massive basis point and time saving. We've seen what that can do with Figure. SoFi has that same advantage, even more so since they were a bank. So it's going to be tough for anybody else to compete that's going to leverage across their loan platform business and their own personal lending products as well. Those are the two things that really stood out to me. There's a bunch of other stuff too. I love the color on the loan platform business. They signed a new partner this week. That they have many that are really close to signing as well. And this isn't just like hype, like, big bank pipeline stuff with tech. No, we've seen a meaningful increase in that. So the cadence of this should improve. And I like the last little bit, and that you mentioned that they're going to execute faster. I mean, we've seen that since last fall. If we continue to see that this year, this gets very exciting.
Yeah. The thing that stood out to me, I actually didn't think they were going to answer it. The individual segment level 2026 expectations. They said lending revenue is expected to grow at 23%. That is way, way higher than I thought. I didn't think we were going to get into the 20+% ranges. So right now, with the additional capital, while they potentially are eyeing some, potential acquisitions and ones that we have highlighted before, like the ability to help with credit cards on the loan or on Galileo and stuff, could be very interesting. While that cash is sitting with them, they're going to do exactly what they normally do with that money, and that's lend it out. So 23% growth there, 40+% growth on financial services, which, based on the commentary that they said with the loan platform business, we just signed a large new partner and have several partners in the final term sheet stages. I thought that was quite interesting. So it probably gets above 40% with the advent of crypto and all their other products that they're pushing. And then the tech platform, as we were just sort of saying goodbye to this line, this product line as it was coming to its final days, said 20+% revenue growth. And it's, they're looking at that after Chime revenue. So that looked really, really strong. They said they were going to sign a massive client here in Q1.
Help me understand that, because I want to make sure I'm getting this right. Are they saying 20% growth? If you just take away Chime completely, like that those numbers were flat, or are they saying despite losing Chime that they will still grow 20%?
So they said it's normalized, so it's as if there was no loss. So it's 20. It's a good 20%. It's not a bad 20%.
All right, guys. So what y'all think about the earnings? What y'all think about the earnings report? Appreciate Crossroads for letting me watch his channel and not caring. I had this thing all set up here. So that I could do it. I could do this on my own. But I didn't trust it. So it looks like SoFi is holding on to the gains so far. I mean, obviously share price is important. That's kind of like what gauges the sentiment more than anything else for retail investors. I don't think so much for institutional investors, because they typically have a longer term outlook. I think just based on where the market is right now and the trajectory right now, with some uncertainty, potentially this Iran conflict, PPI coming in a little hot, is what Angel was saying in the WhatsApp group. Nominating this Fed chair with the last name that I can't pronounce. Crypto tanking. Interest rates holding steady, when I feel like maybe cutting them would have been a real nice boost, a real nice shot in the arm. I just think the pump might be short-lived. What are y'all's opinions? TJ, what do you think about Microsoft? Stock is down. Amit was streaming Microsoft, Apple, or Microsoft, Tesla, and Meta. I had it on in the background, but I wasn't really paying attention. It's my understanding that I think the market doesn't like the CapEx, the capital expenditure. It's a lot like with Facebook or with Meta. They didn't like the capital expenditures until they proved that it was going to be accretive. And I think that might be where Microsoft is right now. It's like the market doesn't really like them committing to spending all of this money if they don't know if it's gonna be good, overall for the bottom line. So I'm not sure. When Moon when Lambo, well, I mean, SoFi has mooned from where it was, right? A year and a half ago. But every time I look at a stock after earnings, the underlying question for me is always this, and this is how I challenge my investment thesis, is how long before the next double? Because I hold myself to this standard of beating the major indices. So when I get into a situation where I can't see a double within the next 3 to 5 years, because per the rule of 72, you should essentially be doubling your portfolio every 6 to 7 years if you're just following the major averages and doing nothing, learning how to golf, spending time with your family, all that stuff, right? So my goal as a wheeler, as an option seller, is to double the portfolio every 3 years. That is my gold standard. If it takes 4, I still feel like I'm doing okay because I'm compounding premiums. I'm not in a situation where I have to live off the portfolios right now because of my consulting gig, right? I manage our entire budget off of the consulting gig revenues. So I'm in a unique situation from that aspect where I could allow the portfolios to multiply and compound. So that being said, I shoot for every 3 years to double the portfolio. Sometimes the opportunity will present itself and you get a double in one calendar year. Sometimes it might take 4, sometimes it might take 5, but the average is 3 years. That's what I'm shooting for, and that's the way that it's worked out going on my 6-year full time. But we'll see. It's still not a long enough sample size. Not enough sample size. But back to the double, and the philosophy is the reason I'm extremely bullish on SoFi. Excuse me. All right. My wife is comfortable in the bed and she needs me to do some honeydew list stuff. So I'm going to be in and out, in and out. We're just going to keep this thing going until the market opens because I want to see how the portfolio is shaking out. I might have to make some moves if we get into margin call and stuff. So I want y'all to see how I, potentially have to navigate that. So that's what's going on. That's what's going on. With SoFi investment thesis is essentially, I'm very, very bullish right now because I feel that SoFi has a legitimate double probably within the next 18 months to 2 years. Legitimate double. I'm not talking about go to the moon. This isn't Kyle White stock goat channel, SoFi to 75, SoFi to 100. Those are thumbnails. That's all just bullshit. Like that's just like mathematically, how does that happen? Like, I mean, with a halfway reasonable valuation. Like, I mean, and Kyle knows the game, but he's also a lot better at YouTube than I am. So I'm just talking about like legitimately. Okay, cool. They got $1 billion in revenue. That's fantastic. You got a PE ratio of over 40. A lot of people argue that at the end of the day, you're just a bank. But now the tech platform might potentially be coming out of the tomb, raised from the dead like Lazarus. So I don't know. I don't know. But and then the lending platform is extremely robust. I don't know. They've got the rule of 40 score, I think came in the high 60s, right? 67, 68, something like that's pretty solid. That's typically used for SaaS businesses, software as a service. So there's a lot of positive takeaways from here. There was also some ambiguity. What was that ambiguity? What was that ambiguity? The ambiguity was they diluted the shit out of us and they didn't give us a clear reason as to what, aside from we just need to have options. So I think when people reflect back on those types of comments, it's not going to be so bullish. Because when you dilute the living shit out of retail, or just all the investors in general, as they have, make no mistake about it, they did. You can make whatever argument you want to make, but at the end of the day, if the freaking share count is going up, it's dilutive. That's it. They're not giving you any more value per share. It's dilutive. There's people that they turn into freaking lawyers and all this other stuff, but I just keep shit very, very simple. They're issuing more shares, and the share price isn't going up in value. However you slice it and dice it, it is dilutive. I'm an expert on dilution because I've invested in the Bitcoin miners. So I know how the shit works. I listen to all the conference calls, and they have a real beautiful way of sticking it to you and making it feel like it was your idea and you're supposed to enjoy it. Because that's the fastest, most capital efficient way for companies to raise money. So as retail investors, that's where we're at. That's where we're at. You know, this isn't like venture capital where you get to invest very, very early in these companies and your big paydays when the companies go public, because then you get to offload your shares to people like us, the retail investors, right? Because I used to be in that arena in 2003, 2004, working for Can-Am Capital in Culver City, California. So I understand that game as well. You know, whenever you're in venture capital, you're providing bridge financing for companies that are trying to go public because there's $1 million, $5 million in fees that they need to pay to apply to go public. So when those opportunities are presented to accredited investors, they get in at much better valuations. And then these companies go public and boom, those shares are offloaded to the general public. And that's how these angel investors and people that are able to invest through different rounds and series, they get paid. All the company has to do is go public and boom, they got a lottery ticket that they're going to cash in. But whenever you're already a publicly traded company and you realize, oh shit, I need more capital, then you got to dilute shareholders by increasing the float. And that is dilutive, you know, and then we deal with this shit all the time now with the digital asset treasuries. Everything that they do is dilutive. People get stuck on MNAV, but at the end of the day, yeah, I could have the MNAV could have been above 1 whenever they issued all those at the monies, right? But then eventually it drops below 1 and it ends up going from accretive to dilutive. So it's all whatever you need to tell yourself to feel good, Blair. But at the end of the day, if you're dealing with a digital asset treasury company, it's not going to matter if the underlying that it's pinned to, whether it's Bitcoin or Ethereum, it's all going to feel dilutive, and it will all mathematically be dilutive if those underlines don't perform. That's just the way that it is. I don't know why people complicate it. They make these little spreadsheets and, well, this is the anticipated MNAV right now. We have all of these shares outstanding, and Tom Lee's awesome. Michael Saylor's awesome because they did these at the monies when the MNAV was 1.6 or 1.4 or 1.2, but then fucking Bitcoin and Ethereum tanks. And then you look up and then the MNAV is going to be like -1, right? Under 1. So I'm just like, whatever you need to tell yourself to sleep good at night. You know, you can believe in Santa Claus as long as you want to believe in Santa Claus. It's all good, man. I ain't here to judge you, but I understand basic arithmetic better than most when it comes to the stock market. Basic arithmetic, man. Just keep it simple. You go get all lost in the sauce with all these fancy numbers, and you're just making a hard game more difficult. Keep it simple. Keep it simple, and it makes a lot more dollars and cents for you. I cannot believe we've already been live, guys, for freaking 2.5 hours. It's a good question right here. Hard to trust this SoFi pump. We could have another government shutdown tonight. Yeah, I really think this government shutdown is. And wasn't there like already an agreement? I feel like I read something that there was already an agreement on the table. I would sell it because, to be honest, it might be 40 in a few years, but the question is it worth it? It depends on whether or not you like to be invested in the company, right? Like, I drive a Tesla Model S Plaid because I like it, and I pay, with insurance about $2,000 a month. Is it worth it to me? Yes. Would it be worth it to the average person? Probably not. I wouldn't even recommend it. That's a lot of money to be squandering on a freaking car. So there's 10,000 tickers out there plus, right, that you can invest in. So you have to decide, is this a space that is worthy of putting in your hard-earned money? Only you can make that decision. And I think that that's the thing that financial YouTube and financial X, they don't understand. It's just like, that's why I would say you can't borrow conviction, because I don't know what your goals, objectives, timeline, your financial situation is, your risk tolerance, how much you like the company, how much you love the sector, how much you love the space, how much you understand about it, etc. That's why it's like all of those things led up to my conviction on this particular ticker. But if you haven't done any of the work and you're like, oh shit, this is just a bank or whatever, then I get it. And that's why it's like people do homework based on how much they feel like they need to feel comfortable with putting their hard-earned money into it. You can't borrow conviction. You can't borrow conviction in this space. You just cannot. This is a really good question here. Which ticker doubles first from here? SoFi to 50 or in phase to 75? Man. I'm going to say in phase. I'm going to say in phase. Because in phase has been forming a bottom for a couple of years. So it kind of feels like when SoFi was trading sideways, down to sideways for, a couple of years, and then it shoots up really, really aggressively. So I could totally see in phase getting to 75 first. It could pull back, right? Technically, if it gets overbought, etc., because it could pump real crazy on some news and then the news falls apart, whatever the case may be. But I think in phase is more of a coiled spring, whereas with SoFi, unless you're really, really new to the stock and you bought it like 31 or 32, whatever the recent all-time high was, then you're pissed off about the price action. But if you've been rocking with it from day one and you've been adding steadily and hopefully you added more into $6, $7, $8, $9, $10 levels, everybody's net positive on SoFi. I mean, I would say 95% of the investors in SoFi are net positive. But so it's not like a depressed stock price. It's not any of those things. People can't be angry at this price movement. I mean, just look at where SoFi was a year and a half ago. I mean, I guess during Liberation Day, didn't it go sub 10 again? Sub 15 for sure, but maybe even sub 10. And then now here we are in the mid 20s. All in phase has done is go down. It went to the mid 20s and then it came back up and now it's, mid to high 30s. At least it was earlier. And then we'll see, we'll see. Morning, TJ. Anything on Meta? Meta's an amazing company. I'm not in it. It's an amazing company. I'm not in it. Been in it a few times. Made some money with Meta. Could have made a lot more. I didn't play it right. And but it's one of those things that doesn't irk me that much because it's like, again, there's 10,000 plus stocks, and it's just not a stock that like I needed to be in. Like I never needed to be in it, aside from the initial public offering. Like I bought into the initial public offering. It took like a couple, 2 or 3 years for that freaking stock to finally like get back to good. So it's been a rough go for me with Meta from the jump. I think the IPO was between 40 and $50. And for me at the time, I went heavy, like around $5,000 to $10,000 because I didn't have very much money back then. And I was like, for me, like I felt like I was all in on Meta. Like I was like, this is gonna be the one. It was Facebook at the time, and it just went down. It went down right away, and I was like, oh shit. So I'm bag holding. I didn't know anything about selling calls or anything of the sort. And then when I built up a pretty decent position, it was a couple 2 or 3 years ago, whenever everything was tanking and Meta went to like the 90s, and I was selling calls, rolling or selling puts, rolling those puts, and then eventually I bought shares. I had 2,500, 3,000 shares, something like that, across a couple of different portfolios. I had a couple Webull accounts at the time, and then I had the big Robinhood account at the time, and then I ended up selling the bulk of the position in the low 200s, and I thought that it was awesome. And then Meta went down after that, and I remember going live on YouTube, feeling real smart. And look at Meta now, right? So definitely just do the math on, let's just call it 2,000 shares and $500 of capital appreciation that isn't there, right? Since then, I've made $200,000 with Meta, like doing some stuff with it, selling puts and calls here and there, naked strangles, that kind of thing. But it's just not anything that I've ever really chased, because I'm just not interested enough to be in that particular space. But great company nonetheless. SLV, what is that? Silver? What's SLV? So anyway, that's the thing, man. That's the thing. That's the thing. So what I need to do now is minimize this here for a little bit and go look. See how bad it is this morning. Let's just go glance at the portfolios here real quickly. I might have to get off. Okay, we're good. The cleaning lady's going to do that errand for me. Awesome. Yeah, but isn't it like at all-time highs? Like, I just feel like there's people that have this philosophy, like just, buy high and sell higher. I'm like a little more old school. Like I want to buy lower and try to sell like in the middle or higher. I just always want to feel like I'm getting a good deal, and I can't see a world where gold or silver is a good deal right now. I'm feeling like Bitcoin's starting to feel like a good deal. Excuse me. Let's see the portfolio. Let's see what's going on with the portfolios, guys. Sorry, low on energy today. I'm tired. This is just way too early. These people are covering these earnings streams all the time. Like, God bless their souls. That's just crazy. It's absolutely crazy. So what's going on? So we're down again today. Down again today. The monies was hit the account yesterday, so it was something, an extra $250,000 gives us a little bit of breathing room. I cleaned up the portfolio a little bit. So what are moves that I'm looking to make? Because I've been looking at this thing a lot here lately. Because why? We're in that yellow line, red line as far as buying power utilization, and I feel like the VIX is spiking yet again. So this thing could all go red as soon as the market opens. And what I mean by that is like go into margin. Like it could go into margin maintenance. Everything will go to 100%, and I'll have to figure out, okay, shit, what am I going to do? So what are the initial moves? What are the things that I'm looking at? If I'm like, oh shit, I got to raise cash. I don't feel like doing it, but I got to raise cash. The first thing that I'll look to do is freaking sell those Enphase shares. I'll look to sell those Enphase shares because that raises about $500,000 in buying power, and that would probably remedy everything. That would probably remedy everything is if we were to somehow go into margin. The second thing that I would look to do is I would look to sell these shares right here, because that's an additional $191,000. So I would look to sell these shares right here, take my licks. That raises another $187,000, right, give or take. So those are the things that I would look to do. And make no mistake about it, I'd be taking a bath, right? Be taking a bath there, $137,000. No bueno, don't want to do it. Be taking another $150,000 bath. Be like, oh, cool, yeah, it's awesome for tax harvesting and stuff because look at all the realized gains so far. Do you screw that? That's a loser's mentality. I don't want to do that. I don't want to do that. That's what I will do if I have to. So we'll see what the buying power usage does here, right? We're looking at it. The only thing I'm looking at right now is buying power usage. We're at 69. So it's going to take a few minutes. It's going to take a few minutes, and then I'll see. We start. But the thing is, the thing that I've already noticed on Tasty Trade is you go from like 69, 70, you go all the way to being in margin. Like there's no gradual progression to it. You know, there's just no gradual progression to it. So that's what I will look to do, is to do that. Other things that I would look to do, let's say that I do all that and it still doesn't work because we have a freaking VIX goes to 40 or something, right? So let me talk to y'all about the oh shit scenarios. So I've already thought about this. Okay, what would I do? I would have to go revisit my thesis on PayPal a little bit, and I'd have to trim 500 of those contracts. I try to wait after earnings or around earnings to do it, especially if the earnings were negative. I'm hoping that they will be good, but that would be like my go-to move. Like, what would I trim? What would I trim? And why would I trim this one? Real simple, because Amazon's red today. And I would rather go add contracts to Amazon over here in the same expiration date cycle, which is 50 days over here, right? 322. So I would add to those 180s, and I could pick up similar premiums to what I would be losing on the PayPal trade. So it would be a net wash in premiums. And I feel like the capital requirement would be more favorable going heavier on Amazon versus PayPal. That's one option that I explored. Another option that I've explored is I just sold these naked calls on strategy yesterday to bring in $80,000. I would see if the algorithm would allow me to sell more naked calls without punishing me. So that's another thing that I would do. I'd be like, hey, can I just freaking double down on the naked calls because those puts in the distance are being an absolute pain in the ass? And I would start experimenting with that. And that brings in another $60,000, gives us another $50,000 of wiggle room, because I feel like I'd have to find $500,000 to $1 million worth. Again, it's like I'm walking all through the mindset of the scramble, right? Like in jiu-jitsu, there's this thing called the scramble. It's like whenever it's kind of like those 50-50 balls in basketball, right? Like the ball bounces funny and it's like the team that hustles, they scramble to the ball. Those are those 50-50 plays. The team that typically wins those 50-50 plays, they end up getting the extra 2 or 3 possessions for the game, and they end up usually winning the game. That's why a lot of coaches emphasize those 50-50 balls. So right now we already looked at this. We already see SoFi. It's not holding up. Now, the one thing that I do got to consider here is we got these SoFi calls, these naked calls. So to me, naked calls is the easiest way to bring money through the door, which will increase our buying power utilization. So I'm kind of thinking about rolling these calls to capture more premiums in case if SoFi were to dump. So I would like for it to pump to like 26 or 27 before doing that, because I would get more premium. So I'm trying to be real patient with it. But this was my number one move this morning to try to raise cash, is like, hopefully SoFi pumps. It holds the pump. It looks like it's pumping a little bit right now, but I'd like it to get closer to 25, 50, 26. And then I would simply like to roll the expiration out another 49 days. But I'd like to bring in more money. I'd like to bring in at least 20 cents a contract. And that's another 29 grand. It's something. It's not a lot, but it's something, because I didn't really hear anything on the call or see anything in the earnings report that makes me believe SoFi is going to go to $36 anytime this quarter. The only way that I think that could like legit happen, interest rate cuts or the Fed's approved all that stuff, and the market just absolutely receives it. Like it would have to be something macro related, but I didn't hear anything in the call that justifies a $36 strike, a $36 price target or price on SoFi. So I don't want to just be done with this play. I want to keep it on, and even if it's bringing in an extra $40,000 a month, oh, it's better than nothing. It's better than a poke in the eye, because I feel like I need to keep this on. Why? Because I do have the $22 puts out there. I do have the $22 puts out. But again, it's not a needle mover right now. So unless SoFi pumps, I'm not going to do that right now. I'll just be happy with this, and it's $10,000. I don't really see a reason to give that $10,000 away. Maybe when it gets like $6,000 or $7,000, I'll be like, okay, I'm just not getting paid any money for the risk to the upside. So maybe I do have to do that. So again, the portfolios are bleeding out, but it's not crazy right now. Truth be told, it's kind of flat. It's kind of flat. So let me go through these real quickly. Account ending in 35. I've got it on 7 days to expiration. So what do we got going on PayPal? We got the 200 calls. These the 200 calls at 65. The naked calls are printing. This is the rich man covered call is what I'm calling it. Instead of buying the leap, you sell the leap. That way you collect premiums the whole way through, and then you run some shorter dated naked calls on top of it to bring in some cash flow. That way, if you ever get assigned those shares, well, you've already got the muscle memory going. Well, I'm just going to sell calls. I've been doing it the whole time. And if the puts are getting challenged, then the calls can't be getting challenged. If the calls are getting challenged, then that means that your puts, which they're going to have the higher delta because they're in the distance, right? So they paid you a lot more premium. That means that your puts are printing. So it's like a little quasi hedge, if you will. BMing you, there's 7,000 shares over here at 544. That part's not great. Right? And we got an agreement to buy an additional 6,500 shares at $4. That part's not great either. I'm excited though, because it does lower the average. So that part's good. And then we got the shares for sale at 7. That part's good. So all that's, steady cash flow. Clean Spark yet again coming down, probably because Bitcoin's down at 82,660 according to this, which is usually off, by the way. That's one thing that's kind of annoying about Tasty Trade is my Bitcoin ticker is always like $500 or $600 under what it says on CNBC. So that's something that I don't know why that is with Tasty Trade, but it's something that I've noticed along the way. SoFi, here we are at 24.22. Remember, we had all of these puts expiring at 24 today. I kicked these down the road, lowered it to 23. I just thought it was the right play, and it's proven to kind of be the right play. Strategy, I feel good about this one in this portfolio, $125. That would be something very, very interesting right there. Something very, very interesting to take ownership, sell some aggressive covered calls, maybe get some capital appreciation. Those are kind of the hits that you need in the portfolio. If you're going to make big moves in the portfolio to the upside, you're going to either have to be right buying calls, whether short term, medium term, long term, buying leaps, or you're going to have to ride some capital appreciation up. If you're just going to rely on selling puts and calls and collecting that premium, that's cool. It's going to be methodical, but it just mathematically, it's going to be very hard to get more than like consistently 25% per year. It's going to be very, very difficult to capture a legit 25% per year if all you're doing is cash grabbing the whole way through, unless you're going to be dealing with nothing but like leveraged ETFs. There's some Matt Giannino, Market Moves with Matt. That's pretty much what he likes to do is sell puts and calls on leveraged ETFs, and he claims 7, 8, 9, 10% a month. And whether that's sustainable long term, I don't know. On TSOL, it's made me a shitload of money. So I'm thinking if you just zero in on something like that, maybe that is sustainable, but I wouldn't with all of this type of money, I just wouldn't be able to do that. I feel like that's just not the prudent play. Palantir is holding up a little bit. I need this thing to hold up. We need to collect data. We need to collect data because this trade has officially turned into a pain in the ass mentally, psychologically for me, because I feel like it's just a matter of time before this thing goes under $100. Like I've felt that for a long time. And, I get that. I'm going to be real thankful that we do have the naked calls on. Curious to see if it would allow me to sell another 50 contracts on naked calls, because I would like to just have a little bit more of a hedge to the downside. And make no mistake about this. This is literally like feeling like buying a put, except we're selling a naked call, because I think that Palantir is going to go south. But you see it doesn't like it, because it's like, nah, it's a serious whipsaw effect there. So we're not going to let you do that. So if there's a huge IV expansion here, I'd probably have to see where I'd have to trim. Bottom line is I'd have to trim. So the sacrificial lamb would probably be to try to get out of BM&U, because it's a relatively speaking, it's a pretty small loss. Or I could look at SoFi, because SoFi is $35,000 of capital. I'll trim that, get about 5 to 10% of buying power there, live to fight another day. It is what it is. It just sucks because that's kind of like an easy win that didn't work out. Yeah, other than that, the only potential pain in the ass in this portfolio, truthfully, that I could see, which was supposed to be the easiest trade, is Palantir. But what I love about this portfolio here is that the strike price is at 130. Everyone else's is like at 140. So that on the put. So that part is good. That part is good. So this portfolio is healthy. I think it's going to be fine. Account ending in 44. We just got PayPal at 52.50. Those are in the money now. And then we're running the naked calls on top of it. And then we got BM&U being an absolute pain in the ass, because BM&R is being a pain in the ass, because Ethereum is being a pain in the ass. That's how it all works, right? It's like a snowball effect. Not really doing anything there. We're just waiting. Account ending in 19. Utilizing way more buying power than I would like as far as what I would be confident in. PayPal, a little bit of a pain in the ass. Fortunately, we did roll these out. We were able to sell a 2-to-1 ratio on the call. So we're going to ring the cash register there to raise cash, right? That's ultimately what we're trying to do. We got 890 in cash. So that's good news. There's a shitload of extrinsic value there of 300 to 1,000. But we do have PayPal that's in the money, right? So ultimately, what do we need for the health of this portfolio is PayPal needs to get his shit together and pump a little bit. That's bottom line is what we need. We needed to get to 54, $55. So not like a massive pump, but just get back to where you were a few days ago. CleanSpark will come off the books at $6,000 in capital. That's not really going to move the needle, but it's just something less to monitor. SoFi's trying, so I feel good about that particular position. Palantir, I do like the fact that there is a 2-to-1 ratio on calls to puts here, so that makes me feel pretty good. I feel like we could just navigate and move those goalposts accordingly. Strategy, it's in the distance. I need at some point, I need to start selling some naked calls on strategy to raise some cash. So that might be something to consider. Let me go look at the big portfolio real quickly. And when did I sell those 200s? 28 days out. So February the 27th. So I may look to replicate that trade across the board, actually, if it'll let me. So that's something to consider. Again, it's not sunny in 75. It's more of a hedge to the downside. It's more of a hedge to the downside, guys. That's all it is. So 27 days out, or is it 28 days out? Is that one it? 200 across the board. Again, how many contracts to have over here? 25. So we'll just match it up at 25 if it'll allow us. So I'm like, if those puts are going to come under fire, let's see if we can bring some money through the door. The algorithm likes it a little bit. Again, it's not a lot of money, but it's better than a poke in the eye. It's better than a poke in the eye. So there's that. Account ending in 19, same deal. Would have been real cool to put them on when strategy was at like 160 not too long ago, right? But that's, it is what it is. So again, we're going to go 28 days out. How many contracts is it? 50. So we're going to go 28 days out, 200. Again, this is just more of a hedge to the downside. Since we're babysitting those naked calls, we got to ring the cash register on the other side. That's what it comes down to. This one was 50 though, right? The algorithm likes it a little bit. It's not a lot of money, but it's better than a poke in the eye. So we'll take it. Account ending in 90. Does it have the same deal? It does have the same deal. So that's something that we can do to just ring the cash register, because I always like to ring the cash register. It just makes me feel real good. And I do. Now this one's getting luckier because now there's going to be more premium there. It's 25 contracts. 25 contracts. Let's go for a little bit more money. See if we can get it filled over here. Yay, a little pocket change. Account ending in 01. I don't see any strategy there. Looks like the buying power usage is holding up. Hopefully it holds up. That way I don't have to make moves that I don't feel like making, that I don't want to make. BMU, we got the 30,000 shares. They're for sale at 7. 25,000 of them are for sale at 7. 49 days out, we're going to go to buy more shares at 10,000 more shares at $8. So that's going to increase the average up to probably about $6. And then PayPal. I rolled these out yesterday to 52.50, and then I'm selling naked calls on top of it, trying to ring the cash register there. Clean Spark at $10, getting hammered again today. So I just got to stick with this one. It's not requiring a lot of capital, so that's good news. So I don't want to give that money back right now. This money is very, very precious for the portfolio right now, so I want to stick it out. SoFi is bouncing back a little bit. It's trying. We did move this out yesterday. It went from 24 to 23. I thought it was just a prudent thing to do. And we just got it. Hopefully SoFi can pump a little bit so we can make that $19,000. That's going to free up quite a bit of capital because it's utilizing $69,000 right now. And then Palantir is the pain in the ass trade. Fortunately, we do have a 2-to-1 ratio here, cost to puts. The move obviously would be to, if Palantir keeps dipping down, the move would be to go from 200 to 180 to get a little bit more delta neutral, if you will, because we got a 35 delta versus an 11 delta. We got $85,000 of extrinsic versus 32,000 in extrinsic. So I want to balance that a little bit, but we don't want to overcorrect and then Palantir shoots up. They have an amazing earnings, and you just create problems. You don't want to have to overmanage these positions. Account ending in 33. What do we got going on here? Days to expiration. Got BMNU, 15,000 shares, getting absolutely slaughtered. Fortunately, we do have the shares for sale at 7, so that part's good. PayPal, same deal. I kicked the can down the road to June at 52.50, and then we're running the naked calls on top of it. So the rich man covered call, if you will, just terminology that I'm trying to coin here on the channel. And then I did a lateral roll on SoFi. Did a lateral roll on SoFi at 24. This is the tasty trade way now, right? Manage 21 days to expiration. So I could consider rolling this out again and going over here. And now the question is do I go after more premium and keep it at 24, or I do the responsible thing and screw the premium and let's lower the strike price to 23? I feel like that makes more sense right now. That makes more sense right now because things feel a little bit sketch with the market. So freeing up a little bit more buying power is always going to be the right thing to do there. We're going to skip the big account for now. We're going to go into account ending in 20. And I'm actually trying to do a move here because I'd like to get to more shares of BMNU. and play it for a big bounce. I play a lot more aggressive on this particular account. So I'm seeing if there's anything that I'm willing to lose money on to free up some capital to buy an additional 25,000 shares of BMU. That's where we're going to stay for a little bit right now, because I'm going to see, like, what could I do? What could I do? Could SoFi's using $126,000 in capital. Could I close? And I made a shitload of money on SoFi in this particular account. You guys can see right there, $446,000. Could I close out 100 of these? Could I close out 100 of these? And what does that do to the buying power? It doesn't really move the needle. It doesn't really move the needle, because how much would 25,000 shares cost? 96 grand. 96 grand. So that doesn't move the needle. What about PayPal? What about PayPal? So what if I closed out 50 contracts? What would that do? And the idea is I would make more money with the capital appreciation on the 25,000 extra shares. It's just the math. It's just something that I thought about last night. Let me just see if it actually plays out. It doesn't really move the needle. I'm basically just getting 1 for 1. So that's not it's not doing what I need it to do. One thing I could do is I could sell naked calls on here to raise more cash. So I'll just match this one up. I don't need it to be like the other ones. I'll match this one up and run the actual strangle over here. So we'll go 200 over here, and it is how many contracts? 100. That doesn't really move the needle either, but $14,000 is $14,000. And again, I'm not fighting for like the best fills right now, because I'm just trying to get this done. Just trying to get this done. But I'm happy with that. Cool extra $14,000 to start the day is pretty nice on that particular account. SoFi is just being an absolute pain in the ass. End phase backstop trade solid. I could potentially look to sell the $45 calls, kind of like the way that I'm running the rich man's covered call on this one. So those are 28 days out at 45. That's something that I could consider doing as well over here. So 28 days out at 45. And I could maybe do 100 contracts. I think it was 200 though, right? Yeah, it is 200. Okay, so let me do that. Let me add another 100 contracts over here. Sorry, there's not like a lot of enthusiasm or stuff. Like this is what I do when I'm offline. Like I'm just real robotic trying to get this shit done. You see, it doesn't like that. It doesn't like that, so I can't do that. Okay. They're like, nah, like slow your roll, player. So you got to listen to your algorithm, man. It will protect you. I already like the situation there to the 2-to-1 ratio on the puts to calls there. SoFi, this one's kind of just shit in the bed. So we've collected 26,000. We've collected 26,000. How much premium is tied to this one? Hold on. I'm just curious how much premium is tied to this one. It's how many contracts is it? 300. Just trying to see what happens if you do 100 contracts. See, that's not, yeah, it doesn't do anything. So that's out. I think we just got to wait. We just got to wait on SoFi. Hopefully the market realizes that the earnings were pretty damn good. But you can already see that shit is tanking, no bueno, and we're already seeing what? The buying power usage coming down. So let me get over here and let me just take the bath that I didn't want to take. The first move that I was going to have to make, I was trying to do it when it was at least at 38, but it is what it is. So the first move that I got to do to raise capital here is going to be, this one's painful. This one's painful, but it's because I'm trying to set it up to buy 100,000 more shares of BMNU. That's painful. That's painful. That was painful. I didn't like that one. But that's going to give me a little bit of buying power back. And I just want to position myself to buy an additional 100,000 shares over here of BMNU and play that for a balance, because every dollar is 150 grand, right? Or every dollar is 100 grand. So that's the thing. But I want to see what that does to the buying power if I were to do that right now. So I buy 100,000 shares. Yeah, what's obviously going to decrease it by 391. So it's going to put me right back to where it was. So now the question becomes, do I say bye to the moonshot play? Because essentially what I'm saying is, do I say bye to the moonshot play for now and use that 199,000 to basically pay for half of those 100,000 shares of BMNU, because I could at least write covered calls on BMNU, whereas here on ASST, let's just say I want to sell covered calls at $1.50. There's nothing. I'm gonna get a penny, 2 pennies, 3 pennies. Like, what is that? What is that? Whereas on BMNU, we do 100,000 shares. That's 1,000 contracts. Same capital, right? Or half of the capital, if you will. So let's just go look to see what that is. Is this BMNU? Yeah. So we just do 49 days out, right? As an example, buy the shares at 3 something, whatever it was, just call it $4. We agree to sell them at $5, and then we're gonna get, or at $6. Because remember, we took a bath, right? On end phase, lost like a little over 100 grand. That part sucked. So I'm like, okay, well, how much would I get on 1,000 contracts? Could 50 grand. It's 50 grand, right? Roughly. It's 50 grand. Over here, I can't get shit. So that's what makes this play so hard for me. I've been looking at that for like a month, and I was just like, shit, man, I really like the idea, but that's why BMNU, especially at these levels, gets a lot more attractive for me, because it's tying up the same buying power. It's still 100% margin requirement, etc. But over here, I can't do shit. The money's just sitting there. Whereas over here, a couple of rounds, 2 or 3 rounds of covered calls, I'm at least bringing in some of that money through the door, right? Like, I buy these shares, and that's going to bring in another $40,000 bill. So I'm just like, that's going to wipe out a third of the money that I would have lost there. So I'm like, I do that over and over and over again. In 4 or 5 months, the money that I lost on Enphase, the money that I lost on ASST, I made it just on the cover call premiums. Now, if I get $1 or $2 of capital appreciation, boom, I'm fucking there, right? That's the math. That's the brain. That's TJ the Wheel deal in a nutshell. That's what I look at. Okay, I got caught my hand in a cookie jar. You're selling options live. It sucks because everybody's going to judge you, but just forget about that. Stay in the math. Does it make sense? Does it make dollars and cents to do that? If you believe in Ethereum, if you believe that they're going to turn the shit around, if you believe in Tom Lee, if you believe in BMNR is always going to raise BMNU, and you're at least getting paid premiums over here. So you have a fighting chance because of the premiums. Over here, you're just, if ASST doesn't perform, it doesn't perform. So that's the one that's tough. It's tough. That's why investing's hard, right? So I'm showing you all of it, guys, the good, the bad, the ugly, and the indifferent. And I wasn't able to find the money over here either, which is kind of annoying. Did bring in $26,000, but I can't find the money to buy an additional 25,000 shares here because there's not a move that I'm willing to make. There's not a move that I'm willing to make to do it. Like I'm not gonna. I just can't do it unless maybe if I turn this into a backstop trade. Like I'm like trying to get creative here. Hold on, trying to get creative. What if I do that? Does that do anything? That doesn't really move the needle. I like it from the standpoint that now I don't have to mess with it. PayPal at 50 is a no-brainer down the road. Don't have to screw with it. And I'm just running the rich man cover call on it now. But it's not really doing anything to the buying power. I need the buying power to get to like 60% in order to have the money to buy the shares that I wanted to buy over here on BMNU. So not able to do it. It's a little disappointing. Strategy, I can't do anything else. I can't do anything else on strategy. Hold on. Maybe, what if I turn this into a backstop trade? Would that give me the buying power that I need to do this? And I'm like, hey, I'm going to be a responsible algorithm. I'm going to go from 125 to 120. Look at this expected move on strategy. Holy cow, right? That's crazy. I go 125 to 120, hell, even 115, because it's not about premiums. It's about bringing up buying power. If I do that, will it reward me? It's fun on the premiums, and it's certainly a lot less risky, right? I mean, we can agree that 115 is much better than 125. It does add another, 70 days or so to the contract. But it's not really moving the needle. It's a fun premium collection day, but it's not really moving the needle as far as the buying power. I just don't feel like I have that play. I don't have that play in me here. If I do something with Palantir and I'm like, okay, this shit ain't working out. Let me go from 140 to 120. Does that do it? Kind of, not really. I can't find the money. I can't find the money, so I'm not able to do it. That sucks. What are y'all's thoughts? What are y'all's thoughts on my logic right here? I get rid of this play. I get rid of this play. End up losing a little bit of money on Riot. Can't remember the last time I do that. Just to clean up the portfolio even more. I get rid of Riot. I close out ASST. I buy another 100 shares of BMNU, and I immediately put those shares for sale at $5 or $6 down the road to get a little bit of a reimbursement, because I need to run that cycle 3 or 4 times to get the money back from end phase and ASST. But now the portfolio is just like squeaky clean, just the way I like it. What are your thoughts? I'm going to check in with the chat, see if you guys are chiming in. If not, I'll just make y'all aren't going to influence my decision. I'm just curious. Where are we at here? How's your BMU doing? Waiting for 3 to average down, $4 put. I guess I just covered BMU, so I did that. It's okay, TJ. We appreciate you. Wow, SoFi, I'm telling you. It's crazy, right? No problem. Take a look at the options chain. Really amazing effort you put in. I love it. My shit show cable service company, is that Charter Communications? Reported amazing results, resulting in 8%. Let's see at some point if I'm green. Start selling cover calls. ASST has been holding strong the last couple of days. I know. It's awesome. Can't sell calls on it though. That's the issue, right? So that's my, and I like the company, man. I've been reading about it. I actually did homework on this thing. Not a lot, like 2 hours, but still, for me, that's homework on a flyer. But I'm like, okay, cool. Lose 150 grand. That sucks. But let's just call it 4 rounds of covered calls on BMNU. And I'm there. I don't know. And then I wait 30 days and nothing's happened with crypto and it's still, call it under 90 cents. I can always buy the damn shares back then because by then I'll have had more monies go over and stuff. So I don't know. Just an idea. Just an idea. It's something that I'm considering, that I'm considering. This one's the painful one here, man. This one is just, and it didn't even move the needle from a capital requirement. It's just about being at 8 tickers. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So let me see what it feels like to lose 10 grand on Riot right now. What does it feel like emotionally? Yeah, it's just tit for tats, whatever. If it fills, that'll be the sign. Okay. If it fills, that'll be the sign. That'll be the sign. Oh, it went down even more right now. Shit. Man, it's SoFi. This is crazy. This is crazy. The market must be getting annihilated. Let me look on Yahoo Finance right now. Let me see what's going on with the market. Now it's really not that bad. Really not that bad. Oh, there it is. That was the answer. Right filled, right? That was the answer. Year to date, look, right? It's going to be negative. There it is right there. Ouch. The last time I lost money on Riot. So I don't think I've ever lost money on Riot. So y'all saw history in the making right now. I never lost money on Riot. Man. I don't think I could resist it, guys. I don't think I could resist it. Oh, man. My little sacrificial lamb. Sorry. Sorry, buddy. Sorry, you're out of there. I'm sorry. I'm sorry. Well, we don't want to do it at 80. Let's calm down. Let's go over here mid. Sorry. There it is. There it is. Man, I'm showing y'all like there's difficult decisions you got to make sometimes, guys. There's difficult decisions you got to make sometimes. But again, it's like I always stay true to thyself. I like a very clean looking hamburger stand. Like it's just who I am in the market. I don't like having a bunch of positions. I was like literally had anxiety when I got up to like 14 or 15 positions, whatever it was the other day. I'm like, dude, I just can't do that. Like, this is crazy. What were you thinking? Like, what were you thinking? So that's the idea. The idea was to buy 100,000 more shares here. That was the idea. The other idea was, is why don't I just load up on this backstop trade on Amazon and I go get the for sure money? So, chat, I'm asking you, what would you do? Because that was my other idea. My other idea was, let's go over here. Let's go over here to this cycle right here and load up on Amazon at like 180. And I'm talking about like load up. I'm talking about like load up, like 500 contracts. And see what that does to the buying power. See if the algorithm likes that as much as I do. 225,000. Hear me out. Hear me out. You say this is a little twist. This is what you call a plot twist right now, right? That just happens to be the amount of money that I lost between Enphase and the other guy, ASST, and the money from Riot, give or take. Give or take. So it'll tell you right here, right? Year to date. We can look at it. Where's ASST? I'm not even going to show a loss yet. This is what's stupid about this thing because it goes based on where the stock was. But y'all saw it. I lost money, right? So let's look at ASST. Maybe it'll tell it to you over here. Where's ASST? Why isn't it over here? Why isn't it over here? It's got to show me that I lost money. Come on. There we go. 61 grand. I feel like it was more than that. It's got to be 100. So let's just call it 100. And then end phase. Where's end phase? Maybe do I got to be on positions for it to show me? Where's end phase? So if I click on end phase, I know I lost, like, give or take 100 there. Give or take. So do I gamble and try to get the capital appreciation on BM&U and be happy with the $40,000, $50,000 extra that's going to be coming in every month to 45 days? Or do I just like, hey, why don't you do the right thing and make Amazon the biggest part of your portfolio? Because it's climbing over here at 9% already. You add these other premiums to it, then it's going to get over here where Palantir is, give or take. Or do you make BM&U, total degen move, and make BM&U bigger part of your portfolio? That's the question. That's the question. So I thought about this a lot last night. And I think that Amazon is, it's no brainer to me. It's a no brainer to me that Amazon makes sense. Or I could do half and half. What if I bought 50,000 shares of BM&U, try to ride those up $2 or $3 quick, because I think it's going to happen quick, Clarity Act, etc. And I go sell a couple hundred more contracts on Amazon. Something like that. Like, I thought about this a lot last night. Like, I didn't sleep that much because I was like, dude, I got to get this portfolio right. Like, and what I mean by right is like to where like, hey, I'm sleeping well at night and I just feel damn good about it. So I'm like, okay, I've got this little ladder that I'm building with short puts. I still haven't even started selling the other side yet. I really like these 160s. I'm like, why don't I add to this one right here? Why don't I add to this one right here? Or I could add 400, that's 800 contracts. Right? I could add to more contracts to the 160s or the 180s. I don't need to add to the 220s or the 200s because that's like sleep easy, but it's not like coma sleep easy. 180s and 600s is coma sleep easy. Like I feel like I can go into a coma and I'm going to be fine. So let me see what that does. Let me see what that does over here. I like to stay in this calendar year to lock in, like the quote unquote win. So I got these at 180. So what if I just match these up at 180? What does that do? Oh, shit. I don't know what I'm doing. Hold on. Do another 200 contracts. What does that do to the buying power? That's interesting. That's interesting, right? That's a good chunk of the money that I was just willing to lose. And I'm like, I feel like that's a winning trade. So that's 200 contracts. What if I had 300 contracts? And keep in mind, as long as I don't exceed the amount of money that we have in the account, because it's is like picking a position that I'd be willing to go all in, if that makes sense. That's like the mindset, the rationale behind these types of trades. It's like, would I be willing to go all in on Amazon? Because I'd have to keep kicking this can down the road, get it all to like 180. I'm like, dude, gun to my head, Amazon at 180. Like, can I sign up for that right now? Can I sign up for that right now? Because that would feel really, really good. Wouldn't be the greatest premiums, but I know I'm not going to lose any money there. Like if I own Amazon, if I went all in on Amazon at 180 versus say strategy at like 165, because we talked about this one yesterday, I just like my chances from a valuation perspective, from a reliability perspective and everything. I just feel like Amazon just is the right thing. It's the right thing. So how do I do it? So it's this way. So it'd have to be 300 contracts, I feel. That's interesting. That's interesting. And that's all the money that I lost. And I'm like, okay, cool. I feel very, very confident that I'm going to go get that money back. And I don't need like a little miracle or anything with BMNU and all that stuff. And I'm kind of like scaling out of all these crypto degen plays, if you will. I don't know. I think that's the right move. I think y'all know it too. It's just not as sexy. It's just not as sexy. So send it, right? Send it. See what happens. Sucks it. Amazon's going that way. I need to go this way right now. I need to go this way right now. I need to go to like 242 and some change. Let me see what's the spread? Where are we at? What are we fighting over? God dang it. Come on, man. Bill one time. Shit. That's the issue with all these contracts is like, $5 per contract's a lot of money, right? That's what's annoying. We'll see. We'll see. But I do feel like, and again, it's only a couple of percentage points, but I feel like now we can handle a volatility expansion. A, B, BBB. There's more cash available. There's more stock buying power available. So if something got stupid cheap, I feel like I could buy some shares and do like a little swing trade or something like that. Let me just go get this thing filled because it's going to annoy me. Like, it's whatever. Like, it sucks. I'd like to get a little bit more money, but this is still a lot more than not getting any. That part really sucks. So let me see if I can get it filled here. Come on, work with me. There we go. That feels better already. Like, I legit feel better already about the portfolio. So now how do we know if it worked out? We go over here and we go to transactions. We go to transactions and it's showing positive 2 million. Why? Because we sold a bunch of shares, but we know that we didn't sell those shares for a profit. So this is probably where I can find it. Is I can look at end phase here. And then I could go to the filter for the last, say, 30 days. And I could go here on stocks. And it'll probably show me where I bought all these shares. You see? 42, 42, 40, 40, 40, 42, 42, 42, 42, 42, 42, and then selling at 40, 90, 40, 90, 37, 37. So you can see legit there that was no bueno, right? Just to show that to you guys. And then and ASST as well. The average was, this is going to be more than 30 days. Let's just go. How long have I been in this trade? 120 days probably. Yeah, here we go. Bought a bunch of shares over here at $1.49, $1.48, $1.50, $1.50, $1.60. Jesus. $1.10, $1.10, $1.09, $1.09. That's how I had a $1.37 average, and then I just sold all of them for 80 cents. So y'all can see there that I legit lost money there, right? Like 80, 90 dollars, like 57 cents. So 57 cents times 250,000 shares is 142 grand, according to the calculator, 142,500. So keep that in mind. 142,500, another, call it 100 grand on end phase. I don't think it was quite that much, but let's just call it 100 grand on end phase. And then the good news on end phase is I had brought in this naked call premium that expires in 28 days. So that was the justification on that. I'm like, okay, well, that sucks. I covered prematurely, didn't have to, because these things expired. These were originally naked calls, guys, on end phase that expired today at 40. And instead I covered the position, and it turns out, that my crystal ball sucks because I didn't have to cover that position. So there's that, right? So just, again, full transparency here. You guys think you're critical of me? Nobody's more critical of me than me. I am like my worst critic, my biggest critic, because I want to get really, really, really good at this game. So the only way that you can be really, really good at this game and get really good at anything is you have to be willing to be objective with your moves. You got to be objective. And so you just got to admit when you screwed the pooch. I screwed the pooch on end phase there. I absolutely screwed the pooch on end phase because had a winning naked call strategy and I bought shares and now I turned it into a losing naked call strategy. I think that now it's going to work out. I'll see this $131,000 and that's going to level the playing field. But it's like one round of successful naked calls. Hopefully it ends up being successful. Is going to wipe out buying these damn shares at $40 and selling them at like 38, right? That sucks. So I'm like, okay, cool. Well, on the next round of covered calls, I get back to good. It's like that Matchbox 20 song, getting back to good. But I'll tell you what I do like about everything that happened here today. What I love about everything that happened here today is the portfolio is not hard to look at anymore for me. It's not, it was difficult to look at there for a hot minute. Now it's like, okay, this hamburger stand, we were under new management and this shit didn't work. I went on vacation, I came back and I'm like, hey, dude, what are we doing? Double meat, double cheese. Let's go. You know what I mean? What are we doing? But the problem is that there wasn't any management. I just had a lapse. Man. Maybe it was shiny object syndrome. I don't know. What it was. But whatever it was, I feel like we're cured. I'm cured. I found Jesus. You know what I mean? So now I look at this Amazon play. So now I go over here to this capital requirement. I go back to the allocation. And now Amazon's showing at, is that even accurate though? Hold on. This thing's not liking what I'm doing here. Hold on. Bear with me. I think I'm getting logged out. Oh man. It froze on me. It does this every once in a while. I don't know if you guys can hear me. Let me see in the background. Oh yeah, you guys can hear me? Yeah. Sometimes whenever I do this right here and I close out, the desktop freezes, so I have to turn off the computer. So I'm going to kick myself off for a little bit, but I'm going to come back on. So give me about 2 or 3 minutes. I'll figure this out and we'll come back. I'm going to have to power off the computer. Restart. That's annoying. And I thought about it before I pushed that button. Still not working. Shoot, I might have to force the shutdown. Hold on. All right, guys, we are back. We are back, baby. We are back. No, I definitely got frozen. I definitely got frozen. And phase is not poop phase. I poop phased it. I poop phased it. I could have just been more patient, and my WhatsApp group was telling me, they're like, hey, maybe you're overreacting buying all those. It's awesome. Offensive stuff is not for everyone. You look good in it for some reason. Are we talking about the which outfit? Hold on. Did y'all see me? Did y'all see me in the McDonald's outfit? Oh my God. OMG. Let me turn this on. Look. Hold on.
McDonald's way.
Hold on.
Serving burgers, sell Hey Save America. One bite at a time, we keep this country strong. That's the McDonald's way. Rich people.
They're roasting me over there on X, man, because everybody knows that I'm getting slaughtered on BM&R. Man, it's so funny. It's just live for anyone, but I send the link. Oh, I gotcha. Anyway. Anyway, where are we at here? Can you hear? You're fine. Yes, awesome. Really steady charts. I love the meme. Thought everybody was part of the BM&R height when it was up. Always the same. Yeah, I walk alone. I walk alone. You know what I mean? That's my song. That is my song. I walk alone. I walk alone. So I don't worry about that stuff, man. I'm very, very confident in what I do. I mean, at the end of the day, we all push our buttons. We got to live with our results. That's just the name of the game that we're in, right? So let's see if we can get back on track over here, because holy moly, just another leg down already. Jesus. Jesus. Another leg down. My goodness. What is it? Well, it can't be in phase because we don't own any shares anymore. What did I sell those shares at, by the way? Did I sell them above where it is now? Did I at least get that part right? Is it activity? I just got to learn how to navigate this a little bit better, man. This is annoying. Yeah, 37.88. So already doing better. Already doing better than where it was at. And then let's go stock the ex-girlfriend. Where's ASST at? At 79. Okay, we're right there. We're right there. So it is what it is. So I'll be stocking those for the next 30 days. If they go down, I'll feel better. If they go up, as long as Amazon's going up, I'll feel better too. So now the only other thing I got to do is I got to go update the spreadsheet. I got to put this at 500 contracts at 180. So let me see if I could do that right there. And cleaned up the spreadsheet a little better, made it a little bit easier on the eyes, if you will. So this one here is now 500 contracts. There's that. Right? So everyone is under how much we could afford. We're good. We're good here. Obviously, I feel like these 160s are irrelevant. I just don't think it's going to go to 160 unless the market has like a serious crash and it stays there for a while. I mean, could it happen? Sure. Of course it could happen. I just think it's extremely unlikely. And then the idea, guys, again, on this ladder that I'm running is July, August rolls around. I'm going to roll these out to the end of the line, and I'm just going to keep this going. And depending on what Amazon's doing, I'll either roll laterally up or down. But I just want to keep this one going over and over and over again. And I want to run 4 different expiration dates, eventually possibly 6 expiration dates. I just feel like I've been trying to figure out how to do this. Like I've drawn this trade up on the board so many times, guys. And I finally convinced myself that I could do this on like 4 stocks, like this same strategy on 4 stocks, and make a very, very, very healthy living and learn how to golf, travel, enjoy the family, all that stuff. That's the idea behind it. Like that's where I'm trying to go because I'm really, 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 I'm really, 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 really trying to make the most amount of money while doing the least amount of work. That's what it comes down to for me. So I just feel like Amazon gives me that opportunity, maybe not to make the most amount of money, but make a fair amount of money doing the least amount of work, causing the less stress, the least amount of stress, etc. This little purplish color, those are the backstop trades, if you will. Those are the backstop trades that I'm running the rich man covered call on. I don't have any naked calls on Amazon yet. That is intentional because Amazon's got earnings here very soon. I want the answers to the test. I want the answers to the test on Amazon. I'm kind of glad that I took off these. I'm kind of glad that I took off these short puts yesterday and I rolled them over here. I took the short puts off yesterday. I had 500 of them on SoFi right here. And because it was like just being a pain in the ass. I don't want to deal with it right now. Like I don't need to deal with this shit right now. I just don't. So shot it over. BMU was at like 390 when I was going to pull the trigger. Now it's at 374. We do have the cash to do that right now. So I'm going to kind of play it out. So now here, if I just do here, I go options only. So this is what we got going on, right? We gave back the 33,000 on Riot and we collected quite a bit of money on Amazon, right? A couple $100,000 on Amazon. So there's that. Manisha's blowing up my phone. Hold on one second. Anyway, so I feel good about that, guys. I feel good about that. I did need to go to over here though, right? And I already did it. Oh, awesome. I already did it. Okay. So we are absolutely tapped out on how much I'm comfortable with over here on total notional. So that is something to keep in mind. In phase, there is just, oh, these are the backstop trades. Okay, that's fine. Oh my gosh. Anyway, so ASST, right? This one. It's not on here anymore. So we're going to delete row 6. BMNR. Don't have any puts. We have the puts on BMNU at $8 for February. And then we got end phase down the road. Strategy at 165. This is the problem area. I am very, very, I feel very, very fortunate that I had I had clarity yesterday and I sold those naked calls. I'm like, dude, what are you doing? Like, why? Like, I refuse to get beat up on the puts and not be taking advantage of the calls. Like, I just refuse to do it. That's just my thing now. What do y'all think about the colors? A little bit better than all the yellow. So I got the total collateral here. Those are the ones that I need to put in yellow because that's the cautionary, right? That's the cautionary right there. So the total and collateral, granted, these don't all expire on the same day. That's the thing, right? That's the thing. So we got Amazon expiring September, November, December, January. Then we got BM&R. I don't have anything with BM&R, actually. The reason I still have this one on here is because I have naked call or covered calls. I'm sorry, because I own these shares. So covered calls at 40 for 227. The issue with BM&R here is the average cost is $44. So that's an issue. And then I gotta do this little deal here at some point as well, but I'll do that whenever I'm offline. End phase, we've got the $30 put in the distance, and then we're running the strangles. We got 1,000 strangles at 45. The other thing that I did consider doing, guys, now that I'm here, I did consider if it will allow me to add an additional 500 naked calls over here on end phase to try to go grab some of that money that I lost on the shares. But I don't know if it will actually let me do that. But then that does bring in like another element of risk. So I'm just thinking that the algorithm won't like it, but I'm just going to look at it to see how bad it thinks of my thought process right now. Yeah, it definitely doesn't like that. You see the $500,000. They're like, nah, we don't like that. I didn't think it would. I was just checking. You know what I mean? It's kind of like when you ask your wife for something, you know, she's not in the mood, but you got to try. You got to try. You know what I mean? I had to try. I had to. I mean, you or me, you would do it too. So that's the thing, man. I feel good about this portfolio now. I feel like the hamburger stand is back on track. We're ready to print money. Let's just go through it real quick. We got the $50 puts in the distance, nothing to think about. And I'm bringing the cash register with naked calls. The freaking hamburger stand is printing money again. We're already up 72% on this bad boy. I want to pump. I want to pump to like 55 or 60. Why? Because then the next round of naked calls is going to be higher. And we're going to get more premiums. It's going to be further out of the money. And then if these naked calls were to get challenged, which I highly doubt, that's good news, because then that means we've recovered on the puts, right? Down 400,000 on the puts. So I'm like, okay, cool. Make 120,000. Got to do that 3 or 4 times, and we're break even on that position. We're manufacturing the win, and we've got the muscle memory going. We're like, hey, if we decide to take ownership of PayPal down the road, we already know how much cover call premium is going to be bringing in, because it's been bringing on naked call premium. And guess what? Cover call premium, naked call premium, same premium. What's the difference? You don't own the shares yet. So that's why I'm really starting to think that this rich man's cover call is just the absolute best strategy that I've ever implemented. I think that is ultimately what I'm going to be known for, because I feel like the backstop trade was like my thing. And now I just added another layer on top of it. Kind of a little quasi hedge to the downside, right? Because that's the biggest thing with the backstop trade is, one, you only qualify for the premium. And then the shit hits the fan. And 2 things. One, you only qualify for the premium, and the cash on cash return typically isn't that high, right? 30% or so. People kind of scoff at it. But now if you couple it with the premiums collected by selling the other side along the way, and if the puts get challenged, well, those calls printed, and typically on a backstop trade, you're selling them pretty out of the money, because let's not forget that on PayPal, we started pretty out of the money. PayPal was at 56, 57, 58 when I started building this position. It's just gone against us. But since it's gone against us, what hasn't gone against us? The naked calls. And I just like it, because it has like a little built-in hedge, if you will. So I just love the rich man's covered call. I just think that is ultimately what I'm going to be known for. This could be book number 2, or maybe Manish, we got to do this thing, and let's just put it in the freaking book that we don't have to do this again. Because I feel like everything that I've done in the stock market up until this point led me to here, because I feel like I've like truly landed on my strategy. Like, this is just what I want to do. It feels the best. Like, it just feels the best, like turning everything into backstop trades. If it's super high conviction stuff that I believe in, and stuff like gun to my head, all in the freaking shares, like, let's not even think about it. So which other one am I looking to turn into a rich man's cover call? Good question. Glad you asked. Palantir's the one. This is something that I'm definitely looking to do eventually. And whenever the put gets challenged, like legit gets challenged. Right now it's uncomfortable, but I can't really say that it's challenged yet. And then they're going to have earnings, a lot like SoFi today. I think they're going to knock it out of the park. They're going to remind Mr. Market of who they are. Mr. Market might not care. Evidently, it didn't care for SoFi. But hey, guys, just so y'all know, this is kind of par for the course for SoFi. It's kind of par for the course for SoFi. Oftentimes, the market takes a day or 2 or 3 to digest those earnings before they reward them. And SoFi typically only ticks up if the entire market's ticking up. It's not a trendsetter stock. It's not like Tesla. It's not like Meta where it could buck the trend is what I'm saying. I've rarely seen SoFi buck the trend. So back over here to potentially turning Palantir into a rich man's covered call. This is what I've definitely considered as well, is going over here, deleting that. That's not enough. I want more time on the clock. So something like over here, the 350-day cycle. And I want to be in this range over here, right here. Right here. Why? Because I think legitimately that's where Palantir could go. And there's still a little bit of a credit there for me. It's going to take buying power. Oh, I'm very surprised that it doesn't. I'm very surprised that it doesn't. So the algorithm likes that move. But F the algorithm. You know who likes that move more? Me. Why? Because now I can sleep kind of like this. Not really like this, because Palantir is still extremely overvalued at 100 if you just want to use like basic metrics to value a company. Still very overvalued at 100. But it's not as overvalued as it was at 207. It would have taken a 50% haircut. And I just think that 100 is like that psychological level. It's that psychological level where I have a real hard time believing that the Palantir army, the cult that they've become, will let this stock dip to $100. I think people do stupid shit like taking out second mortgages and all kinds of crazy stuff because they're going to feel like this is an opportunity of a lifetime. And for me, this isn't, relatively speaking, it's not like as big of a backstop trade because it's $7 million in notional. And then I'm like, I could roll it out again if it craters, like if it really, really craters, roll it out an additional year when the time comes, go from 100 to 80, 175, something like that. And now it becomes very, very compelling. It becomes very, very compelling. Or I roll out to the next cycle. I'm not going to do it right now because I'm like literally going to wait it out. Why? Why am I going to wait it out? Good question. Glad you asked. Because it's collecting $8,000 in theta a day and it's out of the money. So again, you got to be comfortable being uncomfortable because I just study the math, right? Get out of the feelings. I know it feels uncomfortable, but get out of the feelings. There's no money over there. I look at the math. I'm like, okay, $8,000 a day, 30 days, $250,000. What are you down? 320. So this thing can just hold on for 30 days. And there's a good chance that it could shoot up. We have good news over the weekend, something. I know we haven't had that in a while, but let's just say that this time's different. Trust me, bro. Palantir shoots up to 155, 160. Good earnings. Maybe even sees 170 for a hot minute. You're going to feel real, real good that you stuck in this trade for an extra 10, 15, 20 days before rolling. And then it comes back down and then you have to roll again. That's awesome. But you have already taken out a lot of that extrinsic value off of the contract. So you're not rolling over so much negative equity on the used car. So we already know that this feels like a used car. You know, there's going to be negative equity. What I'm telling you is roll when you have to, not when it's uncomfortable, so that you roll as little negative equity as possible, because at some point you're going to have to write out the entire note. You're going to have to write out the entire note, guys. Know what I'm telling you. Know what I'm telling you. I'm afraid to click over here, but I'm going to do it to see if the allocation changed. And it did. You see that? 12%. So I got BM&R. degen, but it was well over 30 at one point. Keep that in mind. And the reason that it's come down is because the valuation of BM&R has come down. It's not that I've reduced the position. It's just the position is worth less. The PayPal at 17, Palantir at 13, Amazon at 12, Strategy at 10, BM&U over here at 9, where she belongs, Enphase at 9, SoFi at 5. Guys, I feel a hell of a lot better about the portfolio already, and I feel like now we're ready to print. Now we're ready to print. I'm back on track. I got my menu items. Something over here would have to get stupid cheap to make it back on to the hamburger stand, because I'm like, okay, right here, I'm good. I got my degen swing trade on. I don't know what I was thinking with ASST. Oh yeah, I didn't know about BM&U at the time. I just didn't. Now I do. So now I'm like, why would I be over there when over here it's just as degen, but I could at least collect some premiums. So now the question becomes, should I at least buy another 50,000 shares to scratch that itch? Let's see what that does to the buying power. Yeah, that's 5,000 shares. That's not what I was looking for. Is it edit order? Is that what I need to do? Edit. Could I at least do that? I feel like I have to. I feel like I have to. I just feel like I have to. Because it goes up $2. That's 100 grand. That's the money that I lost on ASST. I could write it up another $2. That's the money that I lost on Enphase. And I'm able to sell calls on this anyway. So it's going to hurt the buying power a little bit more, right? It's going to hurt the buying power a little bit more, but I just feel like I got to take this calculated risk right now. So yeah, there's the answer. Send it. Send it. So now we're at 200,000 shares and we lowered our cost basis, right? Or whatever we were at before. I think it was like 540-ish. And now we are at 517. And I'm going to look at the buying power. I'm going to see if it still camps out in this level or if there's yet another leg down. If there's yet another leg down, I'm going to consider buying an additional 50,000 shares. So I was able to accomplish everything that I wanted to accomplish. Cleaned up the portfolio. I added more to the degen play, and I added more to this is the staple in the portfolio. What the hell are you doing? What are you doing? PayPal is a staple in the portfolio. What are you doing? We already know that we're going to turn Palantir into the rich man's covered call because we can manufacture the win if the backstop is at $100. I just feel like mathematically we can manufacture the win because we're just one roll away from getting down to like 80, 70. And I don't care what you say, evaluations at that point with the CAGR that freaking Palantir is putting out. It's hard to say that this company doesn't command at least a $75 price right now. It's just, I can't even take you seriously if you don't believe that. It's hard for me to take you seriously because this is a unicorn type of a company. I mean, it just is. Do I need to maybe add more to this Amazon play? I think I'm just gonna let it stew. I think I'm good with that. Well, let's just see how much it adds up to. Because I'm big on math and numbers and stuff. So it's 400. 5, that's 900. 1,100. I need 100 more contracts. I need 100 more contracts somewhere. So where am I going to put those 100 contracts? I'm thinking at the 160s is the right thing to do. One thing to do. So I'm going to go over here and I'm going to add 100 more contracts. The easy contracts. The ones that I just don't see a world where they're going to get challenged even if the macros falls apart. Let's see if I can get them filled right there. we'll see what happens. It's just not going to happen, man. These fills are just not coming in favorably today, unfortunately. Can we get it done over here? Oh, you heard it? Did you hear it? Did you hear it? Did you hear it? Did you hear it? I heard it. Let's just tick it down. We got some of them filled at that level. Thank God Tasty Trade price improves just a little bit. Let's see what the actual fill looked like. Yeah, we got 48 of them done. Okay, that was cool. I mean, it's extra $5. I mean, it's something, whenever you're dealing with that many contracts, it's something. So now I like it better. We got 200, 200, that's 900, that's 1200. Perfect. That works. So now I got to go add the 100 extras on the 160s. 100 extras on the 160s right here. So this is now 300. There it is. We're done. We're done. That was, hold on. What am I doing? Did I get kicked out? What am I doing here? What am I doing here? Did I get kicked? I don't know what's going on here. I accomplished everything I wanted to accomplish. I accomplished everything that I wanted to accomplish. What did, margin might be ringing. It might still be ringing. It might still ring, guys. It might still ring. I'm glad that y'all can get pleasure out of my pain. Guys, I have given y'all some bangers in the last couple of days. I mean, just like not to pat myself in the back or anything, because that's not what it's about. But I have given y'all some freaking bangers. I have walked you guys through the ledge. I've walked y'all through the murky waters. I've walked y'all through the desert for 40 days, if you will. Like, I am giving you guys all of it, man. I'm giving y'all all the insight that I possibly can, because one day I'm no longer going to be on YouTube. I know that for a fact. My wife tells me about it all the freaking time. Excuse me 1 second. Oh, nice. So, 1 second. One of my buddies is texting me here, and oh yeah, there we go. Can't believe the market's sleeping on what Elon said yesterday. It's interesting stuff. Yes, sir. SoFi. I thought the earnings were amazing. I think that the market is not appreciating how amazing they were, but it's also just because the market as a whole isn't doing too well right now. So this is a macro issue. This is not a SoFi issue. These earnings were the best they've ever had. I thought the guidance was really robust. It wasn't really what I was looking for, but it was good enough. It was good enough. Investment thesis intact. In short, investment thesis intact. I think SoFi will pump when the rest of the market pumps. It's going to get rewarded. Noto is going to make the rounds probably. He already went on CNBC. I think he'll probably go on again, go on Bloomberg and wherever else he goes on. I think what he could start doing is taking a page out of Vlad's and maybe going on some selective podcasts to really connect with that retail customer. That's what I think that he should do, but his time's very valuable. He's worth a lot more money than I am. He's obviously smarter than I am. He's got it figured out. He's got it figured out. I think he'll figure it out. So anyway, guys, I think we're good. I think we're good. I'm gonna have to monitor this. Obviously, I don't think we're out of the woods or anything. This is still 10 percentage points across the board, higher than I would like it to be as far as buying power utilization on everything. On everything. Little portfolio is absolutely getting destroyed right now. OMG-bers, right? Fortunately, we do have these shares for sale at $7. We rang the cash register with that. We do have a little bit of money here. We do have a little bit of money here. I did consider maybe buying 300 more shares. I'm not sure if I could afford 400 more shares. I just got to verify that doesn't, like, I'm not actually using margin to buy those shares. So I'm going to Google and make sure that I'm reading that correctly, because I've been collecting, because I collected premiums, bought more shares. I was able to buy 500 shares because we went from 8,500 to 9,000, and I'm just checking to see if I can get to like 9,300 here, 9,400, whatever I'm able to afford there. I just want to verify that. I want to verify that because I don't want to actually be using margin to buy shares. So I just want to make sure that I'm not utilizing margin to buy shares. And I would like to add to a little BM&U hodl, and it could be a very, very glorious day if BM&U pumps. If it doesn't, I got to be willing to lose all of it, right? That's what you got to know what it is that you signed up for, and you'd be like, "Oh, a cover call premium is going to save me." No, because I'm using the cover call premium to buy more shares. So I'm just like doubling and tripling and quadrupling down, and I'm doing a lot of the things that people do with small accounts to try to double their portfolios quickly. So I'm showing y'all what it typically has to happen if you want to try to get those not so reasonable results. So anyway, that's all of it, man. But I hope y'all can appreciate. How I've walked y'all through so much stuff here recently. Anyway, I got to get rocking and rolling, man. I appreciate you guys. I bought another 150 shares on SoFi on this dip. Right on, man. Congratulations. Appreciate you guys. Jesus Red, what's your bad? Try long dated put sales? Are you staying put or rolling it down? No, I'm good. I ain't doing anything. I sold the puts. I stand by that price right now. It still hasn't breached it. And even if it does, I'm probably not going to do anything because I'm ringing the cash register, selling short dated calls along the way. So there's that. Yes, it is. Yeah, it's 80 cents, 79 cents. I would say it's definitely a penny stock. Where else are we at? Anything else? I don't see anything else, guys. I'm good. I got to get rocking and rolling. I appreciate you guys. This is a 4-hour stream. This is crazy. I'm done. No portfolio recap, nothing, unless I have to do something really, really drastic. What would that possibly be? What could that possibly be? I'll leave y'all with that. Like, shit hits the fan. The VIX climbs something super crazy. I don't know. What would I look to do? What would I look to do? Like, let's just stick with this account for now. We've been featuring it the whole day. It's a real good question. Glad you asked. Where would I accept defeat? Because I would have to accept defeat. I'd probably do it right here. And I'll tell y'all why. I'd probably do it right there if I needed to raise cash. And that's not going to raise cash right now, but it would immediately stop the pain. Because the reason I would do it there, I would take that loss right there on Palantir because we made so much money on Palantir. A. B is because I think that Palantir is going to continue to trend down. I'll wait my 30 days and then I can sell the puts again, but do it at like 100, maybe even 80. So that is what I would do to free up the collateral. And then after that, what else would I do to increase the buying power if shit hit the fan? I would then at that point I'd trim these to like 700. I'd trim these to 700. And if I did those together, make no mistake about it, like if I just did this right here, if I did balance right here like that, something like that, that's where the buying power is. So I would stay with 700 naked calls. And I'm like, okay, got my ass kicked over there, but I already got these naked calls on. I'm going to ring the cash register over and over and over again. I'm going to wait my 30, 31, 32 days, and then I'll put the puts on again. And that's the buying power. And that's what I would use to get myself out of the jam. So again, guys, you ever get into this situation, you're playing a little bit bigger than you should, which is, make no mistake about it. That's what I'm doing right now. You got to have all of these contingency plans in place. That way you're just implementing it and it's not just like, oh my God, like you're just fucking pushing buttons, hoping for the best. You're just pushing buttons, hoping for the best. So notice how I went with Palantir and I didn't go with PayPal. Why? Because I stand firm on PayPal. Anything $55 is buy. 50 is a steal. 40, I'm afraid that if I'm able to buy PayPal at 40, I'm going to jail. Like, I feel like that's illegal. I feel like that from a valuation perspective, that would be illegal. So that's what I would do across the board is I would go take a temporary lick on Palantir. If we needed to raise cash across the board, that's what I would do and revisit it in 30 days. Fortunately, in this particular portfolio, it's fantastic because it's positive, right? It's positive. But I'd revisit it in 40 days and be like, okay, we got caught. That sucks. But let's free up all the collateral. Let's free up all the collateral and revisit. I could maybe introduce it, I don't know, to Amazon. I don't know. So there's Palantir's the move. Palantir's the move across the board because I feel like that one's gone bad and it could get ugly. So I would play to that investment thesis. Everything that you ever do in the stock market, there has to be an investment thesis attached to it. You're not just freaking doing price wars and range games and all this other stuff. You always have to play towards your thesis. There's an easy side and a hard side whenever you're selling strangles, guys. It is just very, very obvious. Don't fight the trend. Don't fight the trend. I hope that helps you guys. So I think I just covered that. Yeah, agreed. I got to run, man. I got to run. This has been a long ass stream already. I appreciate you guys. Y'all have an amazing weekend. I don't expect to come back on today. I feel like I've talked y'all through everything. So even if I end up making some moves, I think I could just post them on the WhatsApp group and call life good. TJ the Will Deal signing off. As always, may your sky stay blue, stock screen. Peace out. God bless you guys. Go SoFi.